The market's not going to crash. It's going to be a recession, soft landing. Whenever anybody says that, including myself, just kind of say, I don't think anybody knows what they're talking about. I'm just willing to listen to everybody. All I know is only the paranoid survive.
Yeah, only the paranoid survive. That's for sure. So I'm here with T Max. And what up, T Max? You want to say what's up?
What up? What up, everybody?
And we're basically, we kind of disagree about a lot of the research that PBD has out there. I'm going to disprove a lot of it. I'm going to debunk a lot of it. I'm going to counter what he has to say. And I do agree with a lot of what he has to say. And we're going to jump in that together so we don't waste your time. Here's his opening. I want to make sure that everybody sees. And we have the original video in the description if you want to see that. But here's basically his opening so that you can hear what his premise is first, and then we're gonna dive in clip by clip. We'll stay right here on the side to debunk kind of what he's saying. All right, so we're gonna start off with, I think, this part. And just real quick, before he gets to the balance sheet, he's just pointing out there that this is the fastest hikes in history. This is the fastest rate that the Federal Reserve has ever raised rates. And that's sort of the premise. Think something should break, right? Okay, and at the top there, he says that's how much the Fed bonds are buying. This is actually U.S. bonds, also corporate bonds and mortgage-backed securities. So it's a bundle of all those. Just most of them are treasuries. Just to keep it clear, M2 money supply is just how much money, because the Fed controls the supply of money, so they either increase it or reduce it also. All right. So first and foremost, I have a couple of responses to that. And we're gonna go down the line with it too, because he talks about this a little later in the video. And we're gonna talk about gold also. He does have an ad on gold. Now, first and foremost, he does talk about these something should have broken. He doesn't say that, but he's saying that the Fed hiked so fast, something should break. And I'd argue something did break in March of 2022. We had a banking crisis and the Fed actually stepped in, right? And they're also doing shadow QE. So even though they are selling US treasuries, they have this other facility I call shadow QE, this other facility that is actually buying back US treasuries, not all of them at the same pace, but they're still buying it. So they are supporting the market to some degree. And he hasn't got to that yet. And so, yeah, these rate hikes are going to hit. So there's some research that shows, let me pull this up. There's some research that shows that those rate hikes will hit, because I'm not like, okay, there'll never be a recession, but there is some research that shows the lag effect should start to basically hit the hardest in Q2 of 2024. So we're looking at, this going into the summer, and basically from summer to like October, somewhere around there, though, for next year. Those should be hitting the hardest at that time. So,
and when you're talking about lag effect, what are you talking about? Are you talking about stock lag effect, or are you talking about the treasuries and the bonds?
Lag effect as in it should be hitting the economy, commercial real estate, any interest rate sensitive stocks. So both the economy and the stock market. The stock market typically responds first, and then the economy starts to respond to it. So the stock market could respond in January, but it won't start hitting the economy till summertime next year.
Yeah, and I agree with that, and I think that that's kind of a basis of what we need to explain to the listeners is, when are we talking about the recession? I think that Pat Bet David was talking about 2024, and so I really think we're gonna have, like you're saying, the Santa Claus rally, and then pain will start sinking in 2024. I really think it'll be up front January, February, March 2024, whenever we'll really start seeing the average consumer stressed, the average business starts to get stressed. And like I said, we're not talking about these big funds, even the S&P 500 people. Most medium-sized businesses will hurt, and most consumers will hurt. And I even think most S&P 500 companies will hurt. We could talk about the big dogs and stuff as well. But I do think that that obviously, like you're saying, there is, whenever they start raising rates so fast, something will break, and they're expecting something to break. They definitely don't want that banking market to break, but that's not the only thing that's about to break. Real estate's about to break. Commercial real estate's already breaking. I just had last week, we had a business or building that we were trying to rent, and we couldn't come to agreement on it. And last week, that was probably a month ago, and last weekend, the realtor come back to me, would you buy this building? Would you be interested in buying this building? So that's coming very soon. If not, it's already here.
Hey, real quick, for you guys listening, can you let us know if the audio is working? Somebody told me the audio is not working. It should
Yeah,
be working. You hear it on
I
your end,
couldn't
right, Tanner?
I couldn't hear that first video. I was gonna let you know about that, but I could not hear that first
Oh,
video.
okay. Let me know if you can hear this.
They're right, and maybe
Yep,
don't worry about it, or do
I
worry
can hear
about it.
that
But the
now.
reality of it is, nobody knows 100%.
All right. Hey, audience, can you let me know if the audio, if that audio does work? Tanner, you said it didn't work the first time, but you heard it this time.
Yep, it works this time. The first time it didn't work for me.
Okay, damn. Hopefully that works. Let me know in the comments really quick if that works, so we don't mess this up. That would be terrible. This is the main part, anyways, and he's gonna get to. I'm gonna pull up the website that he actually uses. Okay, nice. What up? Welcome you guys. We're gonna disprove. Well, I'm gonna disprove. I'm gonna combat a little bit of what Pat Bit David is saying. Yes, I hear the audio of the video now. Cool, perfect. All right, so I'm gonna let him talk. All right, he's gonna talk about this. He's going to go through a number of things with CEOs, with recessions, citations of recessions, of recession research, and then I'm going to pull up the actual website, and then we're going to actually go comb through it. All right.
What's going on, because we've never been here before. So let's continue. So then 2024 projections, what's next for the US economy? They did a survey to find out who thinks a recession is coming. Look to the left. The Fed staff says 0% there's not going to be a recession. I remember they're in the business, so they're supposed to be saying that because that is Wall Street, right? Yield curve says 61% chance a recession's coming next 12 months. Economists are at 48%. Consumers are at 69%. That's Main Street, you and I. Goldman Sachs is saying only 15%. Bank of America, 35 to 40%. But look at CEOs, 84%. Okay. C-suites are saying 84%. Now, what would CEOs know that the rest of them don't know? Maybe they know their debt payment. Maybe they know when their debt payment interest rates that they got was lower, that if they have to renew the debt that they got, it's going to go up here. How the hell are we going to make those payments? Maybe we ought to look at what some of these CEOs are talking about. And if you go to the bottom, you'll notice the percentage of S&P 500 companies citing keywords on earning calls. Look at what's happened from Q2 2022 to Q2 2023, what words they're using fewer times. Inflation has decreased. Material costs decreased. Economical slowdown decreased. Job cuts went up, but it's also decreased. So could this be a sign that everything's going to be okay? If yes, why are CEOs at 84% saying a recession is coming? Are they?
Okay.
I would
So
like to know your answer on that, Jeremy. Why do you think the 84% of CEOs say that recession's coming and 0% of Fed staff predict a recession is coming?
yeah, we're going to get to that. Let me pull up the website because this is the actual data he's using. So it's if you guys want to look it up, visual capitalists or capitalist.com, right? So first and foremost, he does say a lot of S&P 500 companies are citing recession. Most CEOs will he talks about that, right? So this is what we're looking at, and basically Wall Street, the Fed is at 0. Okay, That's kind of like, oh, what? The Fed's at zero. Of course, they're lying to you. They're tricking you. Main Street, a lot of consumers, they're feeling it. And then you see the banks, they're not all in touch. Some of them are low, some of them are a little higher. And they've been changing this all year, by the way. This data revisions have been crazy. And then obviously the CEOs are 84%. So I think the big deal here is that CEOs doesn't account, like, companies break every month, right? There's new companies that are failing all the time. So my question is, what CEOs are they actually looking at? Most CEOs will fail. 90% of companies don't make it. So they're always feeling recession, right? A lot of companies are feeling recession. Now, what he did not actually pull up, which was interesting because we're talking about the citations of inflation, that's actually went down. So inflation's went down, costs have went down, and economic slowdown, this is actually, how would I say this, contradictive to what he's saying. Not even what he's saying, but kind of the data in general, which is the economic slowdown citations actually went down. So that counters that. So it kind of isolates, why are CEOs so high then? And I would say most CEOs in the US, most CEOs are feeling recession all the time anyways, and even more so in this environment. That doesn't account for the S&P 500, because if we're talking about the market crashing, here's some other evidence. Let me show you guys another citation. And this is why I was like, I wonder why they missed this. I don't want to say it was biased. Of course, everything's a little biased, but this is the real, this is the other evidence that I have. And this is S&P 500 companies actually citing recession on their earnings calls, right? This is all the mentions of recession on the earnings calls. That peaked in 2022, Q3 of 2022, and it's been falling ever since. Now we're back down to normative levels. So this is the difference here, is we're focusing on the S&P 500, the top 500 companies who, let's keep it real here, that's really going to be, if the market crashes, it's because the S&P 500 crashes, not because some store or some new business crashed that's a startup, or you know what I mean? Like this is what matters. These are what matter. So that's my counter to that, which is
This is what I would say, Jeremy. 90% of businesses do fail, but startup businesses, not businesses that are already in, my business wouldn't be considered in that. It would have been the first year that we started, but not now. So not even half businesses fail, and there's probably 10% of business, 20% of businesses that fail every year, maybe, but it's not a dramatic rate. So 90% of them will fail, but like we're saying, we're talking about the S&P, we're talking about these big cap companies. Even this year, if you take them 7 big cap company, or the 7 of the biggest companies out of the S&P 500, they'll be negative, right? And I do think that is one thing that Patrick Bet-David does a good job of, is he's showing you both sides of the facts right there. Just like you said, he is showing you kind of how he could be wrong in a sense. I don't think he's wrong on the overall market. And I think that this is where we would probably agree. I think last time I was on here, I told you I sold all my stocks, right? That's what I told you. I sold all my stocks. Right. And then you're like, you sold all your stocks? I was like, well, all of them, but a couple of them. I got a lot of stock, right? And so what I did is I liquidated all these small companies and pumped them right into these big companies. So I think that that's what generally people should be doing right now with their money, is starting to figure out, like, hey, I've got a PayPal stock, I've got a Square stock, I've got, some of these random stocks that aren't going to hold up very good during the recession, but maybe these bigger companies, Amazon, Apple, some of these bigger companies can hold up in a recession because they're properly leveraged. We talked about this last time I was on. The maturity wall coming, they're properly leveraged, and any business that's properly leveraged, and is one of the big businesses in the S&P, I'm definitely in for. Everything else I'm out of. So I think that when we're talking about a stock market crash, are we talking about 7 companies, or are we talking about 493 companies?
Right. That's a fair assessment, because what I'm saying here is that, well, guess what? Most of the economic slowdown given by this research, economic slowdown, the dimensions of that is actually falling, but it is the CEOs. It is strictly the CEOs of most of these companies who are citing, hey, we're going to feel it. in the next 12 months, right? And this was what,
So
maybe the last earnings?
the
This was probably the last earnings that we had,
I'm
right?
a CEO, right?
Right.
So the reason why I feel the recession, Pat Bet David's a CEO, right? He
Mhm.
talks to employees, I have about 40 employees. I talk to employees all the time, about how's your life, how's rent, how's, stuff. And we've risen wages as fast as we've ever have in my company's history. And the employees are in turn doing the worst as they've ever been. And I understand, like, how we talked last time, all these, the consumers don't buy stocks. The consumers don't. I think that they do. Consumers buy iPhones. Consumers buy Amazon, and obviously consumers aren't the best with their money, which is
But
why.
listen, the big question is the stock market crash, though. There is a recession, don't get me wrong, but stocks aren't gonna crash because of we're in a halfway recession, right? The environment is actually improving, and this is really the argument here. If the environment is improving, if they're citing recession less and less, but it's just the CEOs at 84%, and I don't even know how you actually pull that data.
Yeah,
Because the S&P companies are literally, there's less mentions of recession, so that's kind of contradictory there. But in general, if we're
but
talking
it
about
shows it underneath there. The less, if you
listen, does the
scroll down.
stock market care about your company?
No,
No, not at all. Does it care about
but
Patrick McDavid's
does
insurance
the stock
company?
market care about Amazon sales?
Yeah. But
Okay.
hold
Does,
on.
does
We're
the
not
stock
talking
market
about
care about
Amazon though.
Square's sales? Say Square's a process, and half of small businesses go under. That affects Square, right? And
Right.
PayPal and all these other ancillary pieces. So it doesn't necessarily it's a web. The economy is a web, and so one thing kind of can pull on other things that we don't really see. Everybody has blind spots. I have blind spots. You have blind spots, and I think that that's why it's good coming at it from these two perspectives, CEO perspective and stock perspective, because I think we'll be able to iron out a lot of stuff for the people listening. I really think, though, that CEOs, what we're looking at, is we're looking at cash flow. We're looking at bills that might not be able to get paid. We're looking at the stress of our investors. We're looking at how hard it is to get money. I was talking to the guy yesterday, about buying that property, and I'm telling him, "Hey, are you willing to sell or finance it? Because the bank ain't gonna loan it." He's saying we're willing to lose money if you can buy at a 7.25 cap rate. And back a year ago, you would be set at a 6% cap rate.
Hey,
I
let me
get that
interrupt you. Can I
8%.
interrupt you?
Yep, go for it.
Okay. What you're saying again, if we're talking about like not moving, keeping the goalpost here, right? It's causing a stock market crash in general. Because I think that's what it is. Are we going to get a stock market crash anytime soon, next 12 months? Right. What you're saying is irrelevant because it's your experience, right? It's not necessarily what's going on today with the overall market. It's a
You
small
don't think
segment.
money's harder to get right now?
Well, we're going to get to that. We're going to get to the lag effects in the money markets. What I'm saying is, because I think what I'm trying to prove here is that we're in a rolling recession. We've been in a recession, and the market's actually is rolling through this. If we
So you
look
think
back
they're
in,
pricing it in? You
hold
think
on, let me
they're
finish. Hold
pricing
on,
January in?
let me finish this and then get to me.
Yeah,
All right. Last year in 2022, right? We're first of all, recession. Can we agree on this? Housing's in a recession right now.
I guess, yeah.
Single family home, maybe not multifamily, single families in a recession.
Prices haven't came down, but buying has stopped. So I don't
Economic
know.
activity, yeah, it's frozen. Economic
Right,
activity, it's not booming, right? It's in a mild recession. It's not collapsing. It's just in a
right.
because a recession doesn't mean you're all the way you're falling apart, collapse. That's not what a recession. It just
Yeah,
means you're slowing down, right?
yep, it's
You're
slowing.
slowing.
You're right.
So back in 2022, technology had the first recession. Amazon, Apple, Tesla was down 75%. Meta was down 75%. They lost in 2022, almost 800 companies shed 473,000 jobs. Technology down 150. Consumer discretionary 108,000. This is a lot of this is Amazon, Walmart. Actually, that's not Walmart, but that is Amazon discretionary. Financials, 50,000 industrials, right? So you lost 473,000 jobs. That's when the market bottomed in October. It's forward looking. And what I'm getting at here is that we're in this rolling recession, went from financials and then it moved over. Why does it keep zooming in? And then it moved over, right? That's your evidence there. It moved over to housing, kind of a little bit. Housing, it didn't fall apart. It's just in a recession. The regional banks are in a recession, but they got saved by the Fed. That's what should have caused the collapse, but the Fed stepped in, right? Regional banks, they're in trouble. The U.S. Treasury market fell. They're in trouble. And then you also have manufacturing, just an economic sector that has been in recession that is now recovering. If you look at the ISM all over the world, manufacturing, China, Japan, they've all been in recession. So what I'm saying here is, well, you would need services to really roll over for there to be a widespread recession, for the stock market to crash. And right now, that's not the case. As a matter of fact, manufacturing is starting to recover, and services are still in expansion territory, right? So to make it clear and concise here, right? Why is it that the CEOs are citing recession? Because they've been in one. A lot of these companies have been in recession. Technology, financials, housing, commercial real estate is in it right now. We'd agree on that, right? Commercial real estate's in recession.
Yep.
So a lot of the sectors are in recession, and they see a lot of negativity. But when you look at what pulls most of the GDP, pulls most of the spending, things could get worse. Don't get me wrong, second half. But right now, right, those earnings calls, the mentions of recession is coming down. The mentions of inflation is coming down. The mentions of economic slowdown is coming down. And
Let me get a broad view of what you think, though, Jeremy. Do you think that we have a recession in 2024?
Mild. If maybe mild. I don't see a stock market crash. The stock market can move sideways or higher while there is a recession. There's been one, and it's been moving higher.
What is your viewpoint on how consumers affect stock market?
Well, hold on. I think the question is, what is a recession? What is let's kind of clarify this. Recessions happen all the time. They're small little recessions. Stock market, sees it beforehand. But I think what you're talking about, do I see like unemployment spike and negative GDP? Is that kind of what you mean when you ask that question?
Yep.
I see unemployment get to like 4.1%. It could go higher. GDP going negative. I do not see GDP going negative. That's what I don't see. And we'll get to the reasons why. Fiscal policy, a lot of that is fiscal policy. It could happen, but I think the probability of GDP going negative, unemployment spiking, and the stock market crashing, I think that's like a 30%. I think it's very low. There's no 100%, right? We don't know, but as of today, looking at the data, I don't see that actually materializing. Most people think it is going to happen because of the lag effects, but I can prove to you those lag effects aren't as big of an issue for the stock market, not the economy, for the stock market, than most people think, right?
I think that the biggest blind spot that we're seeing here is we're everybody's pricing in that these rates are going to come down, correct?
Right.
And they should come down, right? Historically, they should come down. So everybody should be correct. But what happens if these rates don't come down? What happens if the CHIPS app, and I listened to your stuff, and you're always, the Fed's going to pump it, right? The Fed's going to pump it. Well, what happens? Why did we have extreme inflation? Wasn't it because the Fed pumped it too much? And so that's what I think that is, obviously you're like, the Fed's going to save people. Yeah, okay. Say that they save the banks. Say that they save the auto workers. What does that cause? Recession. What does that mean? Jerome Powell can't drop rates. I think we're messing with fire right now. I really do. I think that nobody's being grown-ups. Nobody's being smart with their money. The Fed's over-leveraged. Businesses are over-leveraged. And when people are over-leveraged, that's whenever you got to come home and pay the piper.
When has the U.S. economy not been over-leveraged?
It's never been this over-leveraged, ever.
That's always the case, though. When has it not been it's always over-leveraged, right?
Pop my stock on this right here, and Patrick Bet David, this is one of his charts. This showed you guys the cumulative growth rates of debt and expense. Basically, down here, it's showing you GDP is right here. GDP is in orange. This is our federal debt. In the 80s, we were on par. This is what we should do. We should tie this red line to this orange line, and it should never get over a certain percentage of it. It should be something like that. This and this is greed. That causes bubbles. That causes rich to get richer. That causes people to be able to leverage their money tighter. And that's why I'm like, hey, I'm in the big companies. I'm in Apple. I'm in Tesla. I'm in all these big companies. I'm not in any little company. I'm not in any S&P 500 company that isn't the top 7. And I think that's my strategy going forward, because I see all it takes is one more rate hike when you think it's going to plateau, and markets can start to wobble.
Right. Hey, are we going to move over to this US debt payment, interest payments, right? That's kind of what you're focusing on. Or do you want to get to the Mag 7 and then come back to this? Because we're going to get to this. Say what?
Yeah, whichever. We can go to this if you like.
Okay. Let me skip this ad. Let me show, because since we brought this up, let's go to this. This is basically the US debt interest payments, right? It's unsustainable. It's very unsustainable. It's not going to work. And let's get through this. And then we'll get to the magnets.
Hold on. Can I give you one more chart?
Yeah.
Okay. I hope I don't go past. Oh shit, I'm gonna go past my mean. Okay, there it is. All right. This isn't relevant today, but I think that this is important for people to understand. So this is dumbing down the US process right now, right? So we're just gonna take 8 zeros off of it, and we're gonna act like we're an American family. I'm gonna move you down to this. This is the US debt and everything like that. But this is what we'd be as if we're an average family. Okay, so right now we got average family income 21,700. Money of the family spent 38,200. We've almost doubled our spending from our income. New debt on credit card 16,000. So our new debt is 16,000. We only make 21,000 a year. Our outstanding balance is $150,000 pretty much, and we're gonna cut costs $385. This is what's been happening for the longest. Hold on, Jeremy.
Oh, you're good. I think your thing went out. Here, I'm gonna do this. I'm gonna play while you fix your camera. I'm gonna play the PBD segment on what you're speaking of.
Perfect.
All right, here it is, guys. This is what Patrick McDavid says, and I have an answer to this. This is actually a really good argument to what's gonna happen next. This is why I'm bullish, because the Fed will. Let's get to it. Make sure let me know if you guys can hear it. I want to make sure it is working.
Well, these were all small things we're talking about, right? You know who else owes a lot of money? What corporation in the world owes the most money? You know what that corporation is called? The Great United States of America. You know what's going to happen to them every time interest rates go up? Let's break it down for you. So U.S. roughly owes $33 trillion of national debt. Math would tell you and I that each 1% increase in interest rates pushes the government's interest expense up by, you know how much? $320 billion. Each percent. Each 3% is $1 trillion. Just interest increase, not total, an increase of an additional $3 trillion at each 3%. So just to kind of put that in context, if you look at this chart, look what it shows you. This is the interest expense we've had in US from 1970 till today. You know how it's gradually gone up, but it's not been anything crazy. Then look at COVID. Boom, skyrocketed. How are we going to make these payments? I have no clue, but they're going to come to you and I because it's really our debt. The government is we the people. You and I are running, we hired these people to run this corporation, but they come to you and I to fund it. So guess who they're coming to very soon? You and I. There's certain things you look at to be motivated and excited about the future. You may want to skip this next chart here, but take a look at this chart here. So again, remember this corporation we're talking about called the United States of America? Here's what this is. The green is the tax revenue our government gets every year from you and I. The orange is our GDP. The blue is our interest payment. And the red is our debt, the $33 trillion debt. Look how many years ago in 1980, everything was right next to each other. Just 43 years ago, they're neck and neck. All of a sudden, boom, the red goes off to the roof. Look, it just skyrockets all the way to the top. GDP is a great.
Okay, this was your chart, right?
Yep.
So I want to throw this in here for context for the viewers to understand. The reason why in 1980, that's when we basically got off the gold standard. We were transitioning off the gold standard because why? Because the government could no longer create more money. They couldn't, take your money. They couldn't steal your money by debasing the currency because it was tied to gold. Once they got off of gold, they could print unlimited money. So this has been going on.
In 2008, though. It was gradual until 2008. Then we printed, right?
Right.
influx into $800 billion is all we printed, so it wasn't that big a deal. Well, we printed 2.5 trillion in 2020, and so that's a little bit bigger of a deal, especially when we're already over leveraged. 2020, at 2019, 2020, I feel like we were already over leveraged.
Right. So again, when I always bring it back to when we bring it back to the stock market again, because he's talking about a stock market crash here, bringing it back to the stock market, it's irrelevant. It's really, if anything, this makes stocks go higher. You know who talked about this is Ray Dalio. Ray Dalio talked about this where he was wrong. He lost a lot of money back in the day because he thought that the debt going higher and the Fed printing would be negative. But in fact, let's go to 2000. Let's go to 1980. Hold on. Let me reset this chart. I don't want it like this. Okay. So if we go back to, this is SPX. This is going to be the S&P 500. No, go to a regular scale. There we go. Regular scale S&P 500. I'm going to make these 3-month bars so you can see here. It's a lot clearer. Okay. All right. So going back to 1980. Let's go back to 1980. Okay. All the way to 08. Up 1,600. Did the market care? No. If anything, the market went higher. And this is my argument that the US debt going higher doesn't hurt the stock market. It doesn't hurt the stock market per se. I mean, there's it's more complex than that. It does hurt consumers. It does hurt consumers to some degree, but the market finds a way to go higher because that debt gets used productively to grow certain companies. If you go all the way from 08, right, the crash in 08, and you go up, okay, we crashed in 08, so there was a crash, and you go up here, we're up 600. So either way, the market still moves higher, right? And I'm not arguing for the economy. The economy never, he talked about a couple things here. Interest expenses going higher, right? Federal debt going higher, GDP not going high enough, tax revenue not going high enough. Duh, because right now the economy, the world economy, by the way, is ran off of debt. It used to be demographics, debt, and GDP. GDP cannot keep up. In order to grow your GDP, you have to create more debt. So this is the debt-based financial system that we live in. This is the reality of it, right? More debt doesn't mean, oh my God, we're in trouble. It does not mean that at all. Maybe for a consumer, but you know as well as I do, every business leverages debt. It does come down to the interest payments, which is an issue. And he did say, okay, well, how do we pay those interest payments off? And I would say, well, the way you pay the interest payments off, buddy.
Can you go to my chart real quick, Jeremy?
Yeah. Let's go to your chart.
This is corporate debt maturing, but this is federal interest expense. This is the interest that our federal government will pay on their debt. You see, it looks like right now we're on a straight vertical up, and you could see the trajectory that it has, which means it ain't slowing down anytime soon. I look at charts like this and I know something's wrong with it. I know you can't keep doing that. I know you can't do 10 years of that. I know you can't do 5 years of that. And so people that are over leveraged, and everybody's over leveraged, dude. Everybody wanted Bitcoin. Everybody wanted a house. Everybody, you into credit card debt. Everybody can't afford stuff. I could go into the consumer, the whole thing. Consumer's expensive went up $700. Car payments went up $200. There's so much weight getting put on the average consumer that they can drown. So much weight getting put on our government that they can drown. And I understand there's macro forces to this where, hey, the dollar will always be good because it's the best turd in the punch bowl is what they say, right?
Right.
This scares me though. This really does. This is stealing from our kids' future. This is stealing from the futures. And I understand your thought is, hey, if we could just satisfy the debt payment, it'll be fine. What happens when you can't? What happens, like I said, if something ends up happening and instead of it dropping, it goes up? I actually see one of our comments here. If you could pull it up, it's from Carbides. Failed expectations. Yep, Carbides. Sorry about that. Failed expectations cause the biggest reactions. And I 100% agree with him on that.
So what point are you trying to make with the corporate debt maturing?
This is our interest rate. This is just interest that we're paying on our corporate debt maturing. You see? So
Is that
the
interest? Is that interest or is that, hold on, I can't see. Is that interest or is
federal
that
interest expense. So this is
okay, I see.
interest in billions of dollars. So we're almost at $1 trillion in just interest. Think
Hold on,
about
who is
that.
this?
We're
Is
not
this,
paying down the debt at all. It's $1 trillion in interest. And
who
we're
is
gonna
this
go
though?
to 1.2 trillion.
Who for who? The Fed or for
Yes.
the US government?
The federal government.
Okay.
Sorry.
So yeah, I mean, we just kind of talked about that federal. Why does it say corporate debt maturing?
Because there's another one up here I could show you, but I think that they misread the
Oh,
top
okay.
line. But there's
Yeah.
another corporate debt maturing one that I think that they just use the same headline. But this one's
Oh,
a
okay.
federal interest. There is a corporate debt one I could actually pull up. I think it's right here. Yeah, this is the
Oh,
corporate
okay.
debt.
Yeah. All right. Let's get back to the federal. Okay. Cool.
Okay.
And you're saying basically at some point,
At some point, you can't satisfy the payment even.
right, the US government can't satisfy the payment, and that's an easy fix. I'll just
I
put
mean,
it this
4 or
way.
5 years
Yeah,
print
I'll just
money,
put it this
obviously.
way. I'll just put it this way. You know where those payments are headed?
Where?
I'm going to show you right now. Those payments are headed for the Fed's balance sheet.
Okay, and then what will that do to inflation? And then what
Uh,
will that do to rates? And that's what we got to deal with. We got to deal with if we print more money, then they can't drop rates. And so we
hold
can
on.
pick.
I'm gonna
Jerome
pull it
Powell
up
has
here.
even said it. He's even said, I wish that the Congress would do their job and make spending bills that we can agree on. That way that I didn't have to raise the rates. But if they don't be grown-ups, if we can't get them to be grown-ups, and they can't drop the rates
All
because
right, here's where the debt
inflation
has
is
been
real.
going. This is where the Fed's debt's been going, right? When they print that debt that you're seeing going up, it's literally going to the Fed's balance sheet. The Fed is literally swallowing, they're buying up the treasuries, right? They're eating the debt up. They're pushing it off today, but they're eating the debt up. That's where the debt goes. And you're basically saying, okay, well, if the Fed comes in and eats it, it causes inflation to go higher, right? Okay, then why haven't we seen inflation until this COVID payment? Why we haven't seen inflation
Because we
this whole
printed
time?
$2.5 trillion. What happens is we were in this $800 billion would fix stuff in '08, right?
Oh, hold on, hold
$800
on, hold on, hold
billion.
on, hold on, hold on. I want you to focus on this part first. They ate up the debt, and we didn't get any inflation. Okay, the only right, correct. And
From when?
when I say inflation, I'm saying like the rate of inflation, because we know the average rate of inflation is 2.5%, right? That's kind of like the medium. You don't want it to go too much higher than that. You don't want it too low. By the way, if inflation is zero, no companies grow. You need inflation.
Yeah,
Okay,
I understand that.
so
We don't need 10, 12, 15% inflation. I know that.
right. But what I'm getting at here is that it's not the debt going higher that's the issue, right? Because if that was the issue, we would have seen
No, that is
inflation.
the issue. That's
We would have
100.
seen.
It's not about it going higher. It's about
Well, then
what
answer me this.
percentages.
Answer me this. That's part of the equation. I'm not saying it's not. Answer me this. Why didn't we see inflation go above 3% this whole time?
Because it was proportionate to the GDP. It wasn't astronomical to the GDP from '08 to really from 2012 to 2019. It was proportionate. Then, boom, we realized, hey, all I got to do as a government is give everybody $1,200 and I could pass a $9 trillion bill. People don't know what trillions of dollars mean.
Hold on. You
People
just
barely know
pull up that chart you just had, the chart with the GDP, or did you have that, or was that PBD? The chart
I
of
got both of
GDP.
them.
Okay. Pull
This
up
one.
the G. Is that the GDP one?
And this is what I said. I said the way it should be tied is like this.
Hold
So
on.
you see
Wait,
right here
hold
in
on.
'08.
No. Wait. You just said it was proportionate to the GDP. Does that look like it's
Yes.
proportionate from '08? Going
Okay, we
straight up?
printed money right here, right?
Right.
In '08.
Right.
We
Does
printed
that look
800 billion. So it went from here to here. That's printing money. This is proportionate.
you're
This is
telling
not
me?
proportionate.
Right, but you're telling me that bump in '08 was proportionate to GDP at that time.
More proportionate than this for sure.
Sure, it is.
This is more able to stomach. I'm able to stomach this more than I am this as a business, so as a US citizen, you know. This is
Right.
our money that they're messing with.
Listen, we agree that 2020 was extreme. We agree on that, right? So I'm
Right.
not disagreeing with that. What I'm saying is you said, okay, I'm saying why didn't inflation erupt above 3% during '08 to 2020 then if the degree of printing was much higher than GDP. As a matter of fact, the trend rate of GDP has been, this is a trend, but the trend is very low. Like you're not really getting GDP.
We made one bill to bail everything out, right? So we had an $800 billion bill. We have had tens of bills that are $1 trillion plus in this new government. And the new, over leverage is today's fool's gold. Over leverage is where, hey, and I leverage, but I'm properly leveraged. You cannot be over leveraged. The US government is over leveraged. Anytime you can barely pay your interest payment, and that's what you're going for is, hey, I'm going to pay my interest payment, you are in trouble. You're not paying your debt down, which obviously we've agreed we're never going to pay our debt down. But it can't just keep going. We can't be in 5 years having $50 trillion in debt. We can't be in 8 years having $100 trillion in debt. And that's where we're going right now. And that's unsustainable. That is
Now,
for
hold on.
the
Using your logic, because for one, I think we both know from '08 to 2020, that is not proportionate to GDP. GDP
No.
is average at 1.7%, 2%. That's way faster than GDP, but we didn't get inflation. I'm going to tell you why. We didn't get inflation because there's one thing that beats inflation, it's productivity. If you can produce services and goods as fast or faster than the amount of money printed per unit of labor, then inflation doesn't rise. And we didn't see that. Stocks rose. We didn't see that because of that. During the pandemic, that big bump, the reason why inflation got so out of hand isn't just because we printed so much money. That's part of the issue. It wouldn't have been that bad. Number two, we had a war a little bit, so oil went up. But the real issue here that's been so systemic is that the supply chains were broken. So you couldn't supply goods or services. And when you have broken supply chains, you don't have productivity, right? You don't have. So in order to make your money as a business, you have to increase prices because you don't have.
Are you saying there's no negative cost to printing too much money and
No,
being
no, no, no,
wasteful?
no. I said that's
There's no
part of the.
cost to the stocks.
No, I said that's part of the equation, printing a lot of money. But for an economy, they need productivity because we just saw back in. I can't show
But
the.
is there negative to the stocks? So say we're talking stock market.
No, 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 no. If you're
Is
talking
there
stock.
negative?
No, if you're talking stock market and you're printing more money, stocks go higher. I mean, they go way
Right.
higher. Right.
Right. So you think that you can just put all this weight on the consumer and the consumer will deal with it, but these top richest companies in the world will deal with it or will absorb the money and the consumer will just deal with it. Deal with the cars costing 200 extra, deal with your expenses 700 extra a month, just deal with it. And not only that, we're going to print more to make you deal with it more. And you think that you can just squeeze that consumer as tight as you want and the stocks will keep going. Well, eventually you got to come back to the consumer because the consumer in any good business, that's who you focus on. And the consumer is stressed.
Printing money doesn't hurt it doesn't tighten the consumer. It gives them more money.
No, it hurts the consumer because everybody right now would give back $1,200 if we can go back to 2019 prices. That's just how it works because it costs $700 more right now to live than it did in 1 year ago. Not even, it's probably more like $2,000 less. So everybody would give back that $1,200 if it meant go back to the regular prices.
Well, that's because
what happens is it hurts the poor.
That's because consumers spend more. If there's more money, they spend.
Exactly, more in debt. Then they're in the same predicament as our government is.
But those are individual choices. Those are choices by the individual, though. That printing more money doesn't hurt them. Tightening rates hurts the consumer. Tightening rates hurts the consumer. You have to
tighten rates. You have to tighten rates if inflation gets out of control. If we print too much money, we have to tighten rates.
Right, but the argument here is that
correlated.
Right, but the argument here is that inflation wasn't caused so much by just well, this is the point I'm making. It wasn't caused by US debt rising. It was caused because the supply chains broke. Because from '08 to 2020, you didn't have inflation breakout. So it's not debt. It's not debt that made it go up. It's the broken supply chains. It's the lack of production.
I don't think it's either or. I think there's a combination of it, but I do think that it's at least 50-50 if we're going to say those are the two causing factors, because you can't just inflate the economy. You can't just put that much more money into the economy without it hurting the consumer, which we're seeing with inflation.
But we're
Inflation,
talking
I
about the
feel like,
stock market. But we're talking about the stock market here, right?
but who buys Amazon? Does Amazon just make money just because people buy the stock, or do
Listen,
Amazon have to sell goods?
when you print money, the inflation goes into asset prices. That's what goes up the most. Asset prices go up. The cost of consumers like apples, whatever it is, your food, your groceries, your housing, that does go up. But you know what goes up the fastest? Asset prices. That's why Bitcoin is so popular, because anything that can store value while they print money goes up faster. So the argument I'm making here is people should be investing, because that's the only way to capitalize on the debt payments. It's going to go up. If you take off debt printing from the government, guess what? You're going to a third world country. They have to print debt. There's no
Let me
way
show you
out of
this
it.
chart real quick, Jeremy. I think
All
you'll
right.
like this one. This is a funny meme one. So this is the government right here, right?
Yeah. Mm-hmm.
And then this is their two options, right? We could lower interest rates and cause inflation, or we could increase the interest rates and cause a recession. And I do think that is, like I say, we can act like they're not connected, but I do think that it's connected. That if you print more money, Jerome
Mm-hmm.
Powell has to keep the interest high. If the interest is high, it hurts companies that aren't leveraged properly, which I guarantee are over 50% of companies that over leverage, think that free money's forever, think all this stuff, and it'll stress the economy. And so,
Yeah.
like, the economy does have a play in stocks. Obviously, people buy consumer goods, so that does. Obviously, there is a portion of it that the economy doesn't have. If we're looking at just, hey, influx money, anytime we influx money, somebody that is set up to absorb money is going to
Mm-hmm.
do good. So that's what you're talking about, Amazon and stuff. But what I'm talking about, and I think that we're saying similar things, because I
Right.
don't think that you would invest in the 250th best company in the S&P 500, would you?
I'm not going to invest in a company that's affected by how the consumer changes their habits, basically. Yeah. So what I'm looking at is the overall stock market, or the assets that outperform. Maybe that's where we're disconnected, which is, yes, the stock market's going to be impacted, but overall, over time, it's still going to outrun. The economy can be flat and the market can still go higher in certain segments. And overall, we just saw when the Fed prints money, the economy suffers in some areas, but other areas it does better, because guess what? They're going to print that money and it's going to go somewhere. Number two, just because they lower interest rates, that doesn't make inflation go higher. It's whenever you cannot produce anything, and it's when the banks lend money. You can print money and inflation doesn't happen. We saw that. Or else, guess what? We'd have saw inflation from 08 to 2020. It didn't happen. Why? Because banks didn't lend as much. And money printing isn't inflation. That's a misconception. Inflation comes when the banks lend out money when they try to make money, and they lend to people who can't afford it.
Inflation
Or
is too much money chasing too few goods. Whenever you print more money, that causes
yeah,
inflation. It's 100% what
no,
causes.
because guess what? We didn't see inflation from. That's what I'm saying. You'd have to explain why 08 to 2020 there was no inflation above the 3% level, 2.5%. You can't explain that, can you?
From '08, whenever everybody was it was recession and not
Gotcha.
inflation.
Where's my button at? Gotcha. Explain if that's true, if what you're saying is right, we would have seen inflation, is what I'm saying. So how do you explain all the printing from 08 to 2020, 2019, whatever, and no
Dude,
inflation? How do you explain that?
dude, you went to business school, right?
No, I didn't go to business school. No.
Or you were you in marketing?
No, I got mine in family child sciences. What? Well,
Okay, I
hold
thought we
on. How
did
do
a
you
marketing class together. Sorry.
um
But all that it is inflation is too much money chasing too few goods.
how do you explain 08 to 2019? You're skipping my question. You're trying
They,
to deflect here.
they printed $800 billion, not 2.5 trillion in 1 year, and then keep going. These CHIPS Act, all this stuff that you keep acting like, that's 1.7
No,
trillion, 1.9 trillion, 8.2 trillion. It's tons of money. It's
listen,
not $800 billion. It's not going to cause the
you're
same
moving
reaction
the
if I
goal. You're
do it.
moving the goalpost from 2008. You're going backwards from 2008 to 2020. The
It was
the
$800
hold on.
billion
Let me
that
finish.
we printed off,
Let me
not
finish.
2.5 trillion.
Let me finish. They printed money though. They increased the money supply significantly versus the past. You have the chart from '08 to 2019. It significantly increased right there. There it is, '08, right? So how do you explain
This is
the fact?
significant to you? Look at this. Boop, boop. That's
Yes.
significant. Let me show you what's significant to me. Boop, boop. That's from 6,000% to 8,000, over 8,200.
I'm not arguing that though. What I'm saying is that in '08 they printed money. You're literally saying, and when you print money, right, significantly
Proportionate,
versus
Jeremy, proportionate. If
that's not
we printed
that's not
$800 billion in 2020, we wouldn't be
bro.
dealing with this right now.
'08 to 2020 was not proportionate. Look at the chart. Anybody with eyes can see that the chart left the trend of GDP and tax revenue and what is that? The federal debt. The federal debt left interest payments, all that stuff. The interest payments are what increased, right? Are increasing today. But when you go to '08, printing money did not cause inflation. It's right. There was no inflation from '08 to 19. You got to be able to answer that question. I think we're beating a dead horse here. I'll give you the last word on that, and then we'll move on.
Man, guys, this is crazy. People have to be able to understand over leverage. Over leverage, everybody wants to be over leverage. Over leverage is what can cause these stocks to go down. And like I said, I'm not talking about the top 7 stocks. I'm not talking about all this stuff. I'm talking about the average S&P 500. I'm talking about the average index. The average company will come down because we are over leveraged. They are over leveraged. The consumers over leveraged. The federal government is over leveraged.
Okay, cool. And that's why we don't pick those trash companies. That's
that's why you follow Jeremy.
Yeah, you choose the companies that are going to benefit from the
Hey man,
leverage.
and I'm waiting on those classes. I hear you talking about the classes and stuff. I'm waiting on them, dude.
We just got it started. I'm working on that. It should be ready by January. There's some bugs because we're doing this by hand. We're not hiring another company. We're doing it straight from scratch. It's all our money, all our stuff. So it's going to take a little longer, but I want it to be quality. Those will come out.
And that's what I was going to say. Anything that, Jeremy is going to do some quality shit, guys. So be ready for it.
Hey, I appreciate it. But again, or actually, let's turn back. Okay, so we did a long rant on that. We're going to move over to the Mag 7. This is a really good argument, actually. The Magnificent 7. The question is, actually, let's go through some of these comments really quick.
Yep, comments.
Do you mind reading through them so I can get the next slide ready?
So Gervine, printing more money boosts household cash, but without increased goods. It leads to price hikes. Jeremy's point stands. Productivity is key. And I understand, especially with AI, productivity is going to boost. But like I'm saying, if we're talking about the top companies, then I agree with you guys. If we're talking about the average company, I don't agree.
That's like talking about marriage and then you're talking about the ugly. No, I'm just playing. We'll get into that next.
Well, the average stock is the average person. I wouldn't say the average person buys the average stock like PayPal or something, but
right.
that's the stocks that whenever I was a young investor, that's what I did. I diversified, have 15 stocks and tried to, do all this stuff. And that's why I said, I think that now I'm becoming more smart and being like, nah, I'm going with these people that are properly leveraged, that don't have to come back into debt and can absorb some of this money that's going to get printed out. Because I think that that's the biggest reason why you're bearish on Bitcoin, is because if people understand what's happening to your money and how it's inflated, bullish, then if people understand what's happening to your cash, then people will be like, I would rather set my money in Bitcoin, especially when it stabilizes.
Right. Yeah, it's gonna boom. All right. So we'll actually hold on. My bad.
One more. Okay, go for it.
Failed expectations cause the biggest reaction. Yes, we're gonna see Tesla earnings after hours. Everybody's expecting Tesla to have a crappy quarter. That might be true, but typically when the price is declining, right? And this is part of market psychology. We'll see from right here, Tanner. Tesla is margins are falling, right? Margins are down. Everybody's negative. Sentiment is down. I think the price is falling right now. This is a great setup for actually Tesla to rip higher. So we'll see if it actually happens. I'm going to give it a 50-50 chance. It's not a great chance because the market is moving down. If the macro forces were stronger, or weaker, we would be moving up. But right now, the dollar's up. Interest, mortgage rates, 30-year rates just made a effing new high. Damn it. Oil's kind of, oil's still elevated. But if that wasn't the case, I would be like 75% Tesla goes higher. But we'll see. It's gonna surprise people. Anyways, Yellen is gonna implement that $1 trillion platinum coin. That'll be interesting. We'll see if that comes into play. To delete the debt, it's going to go on the Fed's balance sheet, guys. The debt always goes to the Fed's balance sheet, which is why I think we're going to see more money printing going into the next quarter. You're going to see Fed start eating up that Fed balance sheet is either going to start going sideways or going up, or they're going to cut rates at some point. It's going to the Fed's balance sheet. Tanner is right. It is unsustainable. The debt interest payments for the US are way unsustainable. It's not sustainable. It's impossible. It has to go somewhere. Do you think they're dumb enough to know that? They have experts, financial experts that already know how to financially engineer this to keep going. And guess who they're going to take from? They're going to take from your labor, your purchasing power, which is why you have to be invested in something that's going to outrun the Fed's balance sheet at the end of the day. So we both agree on that.
100%.
We're screwed. Printing more money boosts household cash, but without increased goods, it leads to price hikes. My bad. I already read that. This is why 2020 was horrible. Low supply, more demand, free money, inflation. And that's to your point, 100%. Debt to GDP isn't too bad for US. It's 121% of the country's nominal GDP. Countries like Japan got 259. Yeah. And that's going to continue. That trend. That trend where debt to GDP, it can only go higher unless GDP goes up. Guess what? GDP goes up through demographics, but right now the population growth is falling. The other way you get GDP up is debt growth. Well, debt goes higher, GDP goes lower. So the only way out of this, guys, and I'm going to write about this, we're going to talk about this, is productivity. How do you get productivity up? You either get more people in the labor force, which isn't happening worldwide, or technology booms. Technology creates it. Energy storage, blockchain technology, artificial intelligence, robotics, taking the cost of energy down to nearly zero using solar, nuclear, whatever it is. So tech is where you invest. Technology is outbeating the Fed's balance sheet in general. Okay, we're going to get to this next slide. I'll have him open up, and then it's about the Magnificent Seven, pulling the stock market. And then let's make sure that this is, there we go. I think this is it.
Can't hear it, Jeremy.
You say you can't hear it?
No.
All right. I think I know what happened. Let's make sure. Boom.
Part of my portfolio.
You hear that?
Yep.
All right, cool. Move this up to 5 minutes. We're at 5 minutes. And this is where he talks about the Magnificent Seven right here.
Look at what's happened from Q2 2022 to Q2 2023. What words they're using fewer times. Inflation has decreased. Material costs decreased. Economical slowdown.
My bad. We went through that. Here it is.
On to S&P 500. These are the 500 biggest companies in America. Something very interesting is happening. There are 7 companies that make up 28% of the S&P 500. Let me break this down for you. 500 biggest companies, 7 companies make up 28%. In the history of S&P 500, never has there been a time where 7 companies make up 28%. We've never had 7 companies. Too big to fail. We've never had 7 companies. Now, what are these companies? You got Meta, Facebook, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. So why is this important? Here's why. If you look at the S&P 500 year-to-date returns, you will notice a number roughly around 12.4%. Could be higher, could be lower, but it's around 12%. You know what Magnificent Seven's return is for the year so far? Roughly 92%. So what happens if you take the 7 stocks out and there's only 493 stocks left? How's the S&P 500 doing? It's down. So the 7 are pulling the rest of the market, and it looks like everything else is okay, but is it really? So we decided to break it down to see how small cap companies were doing, mid cap companies were doing versus large cap companies. And you will notice a trend here. Watch this. Okay, so if you look at this chart, you'll notice 3 different funds here. One is the SPY, which is the S&P 500. The other one is the Russell 2000. Then you have the micro cap ETF. So if you look at these, the S&P 500 is companies valued roughly at $12.7 billion or higher. Top 500 biggest companies in America. Russell 2000 is company size is $300 million to $2 billion market cap. And then the micro cap is from 50 million to 300 million. So if you look at this, what do you notice? You'll notice SPY is up 18.66%. The rich get richer, the big get bigger, the stronger get stronger. Great. Russell 2000 is only up 7%. But look at the micro cap. Micro cap companies are down 1.85%. So why is that? Is it the bigger guys can afford to go through a season like this? They can weather the storm and they can kind of handle it because the amount of cash they have and capital they have, and the smaller guys cannot? Possibly, but we cannot fool ourselves thinking the market is up just because these 7 magnificent companies are carrying the weight. So far, the reason why the market hasn't crashed is 1, Magnificent 7 is holding the S&P 500 high. So people are like, it's going to be okay. Number 2, unemployment is super low.
Okay, he's going to go into something different there. Let me pull this back to where he's highlighting the big company. There it is right there. So this is sort of the argument, which is something to think about. And I don't think it all depends on your perspective here. Basically, the Magnificent 7, Meta, Nvidia, Apple, Microsoft, Alphabet, Amazon, Tesla. You could put Netflix in there, even though they're crap in the bed right now, and say that they're holding up the S&P 500. And so the stock market's not actually doing that great. It's mostly these 7 companies. Would you agree with him, Tanner?
Yes.
Okay. Now, my thing is, okay, sure. A lot of the game, you're right. The micro cap. So if you look at the Dow is okay. The Dow's not doing terrible. He didn't mention the Dow though. That was interesting. And the Dow is mostly value stocks like McDonald's, Visa, Monster. And then you have the IWM, which are the small caps. Now, what was interesting here is that PBD only pointed out the companies who suck the most, which are the small caps. He didn't compare, right? He didn't compare the actual S&P 500 companies. He didn't actually compare the rest of them, by the way, because there's a bunch making all-time highs. They've been doing it. Monster Energy Drink, Pepsi, McDonald's was at all-time highs. There's a bunch of companies who are hitting all-time highs, but the fact of the matter is the Magnificent 7 pull most of the weight because they pull most of the earnings because you use them every day. You're on Facebook every day. You're on it right now. You're using, Twitter, which is going to be owned by Elon pretty soon here. NVIDIA, you guys don't use NVIDIA, but it's the most widely used. AI is all about NVIDIA, right? You guys all have Apple iPhones. You're playing Xbox. You're using Microsoft technologies under the hood. You don't even know it. You Google every single day. You're watching YouTube right now. So you're using Amazon to deliver your stuff, and Amazon AWS, every freaking website uses it. So this is the future of the economy. It's technology. Why is that weird? When the stock market crashed in October of 2022, guess who led? Meta, NVIDIA, Apple. Apple stayed up a little much. Meta, Nvidia, Tesla, Google, they all tanked. They led to the downside. Why would they not lead to the upside? Would you see them lead to the downside and say, the stock market's not really crashing, let's buy it because it's just the Mag 7? No, you'd be like, damn it, the big companies are tanking. That's a bellwether. That's a signal. That's a telegraph. This market is weak, right? And so why is it weird that when they lead to the upside, oh, the market isn't strong? Okay, great. But what market are you talking about, right? That's why you invest in certain companies. It's irrelevant. It's irrelevant whether who leads in or out. What's relevant is the overall market conditions improving and our earnings going higher. And right now, earnings are leaving a recession right now. We're leaving the earnings recession as we speak. So I think PBD, he's giving a very fair assessment, probably you too, but there's more nuance to it, which is there's other factors. There's more other factors involved. And like I said, McDonald's was making all-time highs, Pepsi all-time highs, Monster Energy Drink all-time. There's a bunch of stocks that were making all-time highs while the Magnificent 7 were not. So
and I think that coming up, it's going to be a lot sector focused or even industry specific on what does good and what doesn't. Obviously, we've talked about, interest being high. It's going to be high for several years. Any company that deals with interest is going to go down. Banking stocks, obviously, we know are probably not going to do good. Real estate stocks, Zillow. I had Zillow stock. I sold Zillow stock. I had EXP stock, sold EXP stock. Because my wife's a realtor, and so I understand the market and how it works, and kind of nothing's moving right now. So I know we're stopping advertisement with Zillow. We're stopping, so I could see the trickle effect of how that could work. So I do think that certain specific sectors will do fine, like we're talking about these 7. Fine, I got investments in every one of them. But I do think that it's more important than ever for the consumer to do the research, for the investor to do the research on it, because it's not just pick them and, they go up, or the S&P 500 is going to go up. You're way better off having your money picked in one of these specialized Amazon companies than the S&P going forward, because they have a bigger boom to them. There's more risk, but it's not that much more risk. You think Amazon's going to go to zero anytime soon? No. And like you said, Jeremy has more specifics on them, but several of them are properly leveraged to debt past 2029, which is going to be important, because hopefully by then we can see an ease in kind of the interest rates.
Right. So maybe we don't too much disagree on this. Listen, there's always a bull market somewhere, and there's always a recession in the market somewhere. So his point to the Magnificent Seven are masking it. It's a popular view that people use. Why? Because they're not in the market and they want a market crash. And typically, when people want something to happen, they keep telling themselves, "Well, it's going to go in my favor. The market's only up because Meta, Nvidia, Apple, Microsoft, Google, blah 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 blah." Well, okay, great. So they generate more revenue, they generate more earnings, and then that means their employees spend more. That means the economy is more stimulated. It's like a vicious cycle. And at the end of the day, look, it's about the macro environment right now, and who can earn when inflation is moderately high. It is coming down on a rate of change, but inflation is high. That's not the big deal. These companies benefit from inflation, by the way, right? Most companies do.
100%.
Where they get crushed is interest rate payments that are too high, right? The Fed funds rate is what crushes them. My argument here is, okay, so the companies, which is the he mentioned the small caps, which is the Russell 2000. Well, yeah, the Russell 2000, those companies are unprofitable, by the way. They don't have an earnings. They're not positive. They're still trying to collect cash. They still have to refi the rates more frequently. So they're going to suck, which is why you don't buy IWM. You don't buy you guys probably don't even know who they are. So duh.
And I think that the reason why he talks about the S&P 500 is because a lot of people invest in the S&P 500. And, obviously it's like, oh, hedge against inflation. And I've got videos in it. I deal more with like the average person. So I got videos even telling people invest in the S&P 500 because it's a safe bet. It's something where if you're not, Jeremy's followers, you don't know where to spend it. Where do I put it in? I don't know. I'm just going to go S&P 500. It's a good hedge against inflation, maybe, is what you get. You really don't make very much money off of it, but it's a good hedge against inflation if you don't know what to do. So I think that that's why Patrick Bet-David brought into the S&P 500, is just because it's a dumb man's game of investing.
Right. So now, I would put it this way for the crowd that are listening, or if you guys are new, who's going to benefit in this environment? Listen, the stock market's going to continue to chug higher unless there's a black swan event. Could be the war. But here's who can still do well with these high rates for going forward. Not the housing market. They're going to stay frozen because rates are too high. But guess what? Premium stocks are going to do well. Why? Because if they have low debt and they have cash flows and they can continue to earn those cash flows, they can buy back their own shares. And if they can buy back their own shares, they're reducing the amount of shares in circulation. They're creating more scarcity, and it increases their earnings per share. And that's what investors want. They want their earnings per share to go higher. It's called EPS. And that's the most important thing to shareholders, that the value of their investment goes higher. So that's what that does. Also, they are increasing their efficiencies, right? So they can retain more margins by cutting costs. You saw that technology in 2022, the reason Meta, Nvidia, Apple, all these companies bounced and went much higher, like Tesla, they can cut costs really quickly because they're mostly software. A lot, not Tesla so much, some of them are not, but a lot of them can cut their costs by eliminating a lot of brick and mortar stores, infrastructure, and just use software. And then they can get rid of software engineers and use AI, so they can cut their payrolls and still generate revenue and stop doing, they have so much cash, right?
The two easiest things to cut in a business is employee cost and marketing cost, right? Because marketing, I see it in 6 months. I don't need it. I could cut it right now. I won't feel it right now. And employee cost. And like you were saying, sometimes when you cut employees, actually stocks benefit because their bottom line gets better, basically. I think that even bigger than that, I really feel like this AI is going to take whole sectors off of the map. So I think CDL licenses, right? you probably shouldn't be getting a CDL right now if because those jobs will be automated in 10 years.
What is that? What is a CDL for the audience?
Okay, CDL is a truck driving license. Basically, it's what, anybody that drives a semi has to have a CDL, or an 18-wheeler, I think, has to have a CDL. And they get paid good. They get paid $40-50 an hour to drive these trucks around the country, and they should, because tough on their back, but they get paid a lot of money. And those jobs, if a company's like, hey, here's a $500,000 truck, but it automates self-drives and stuff, and you don't have to worry about all the stuff because it'll send something to the department. It doesn't even have to stop at the stop because it'll send something to the department, say what the weight load is, and it'll it's gonna run 24/7. It's not gonna have to take breaks. It's gonna make stuff more efficient in the transportation system. Once you see Elon doing the taxi services for his Tesla, or the self-automated driving, I see, with my wife, she has to drive to sell houses and stuff, and she tries to be on her computer, so I'll drive her sometimes. And sometimes, if we just bought a self-driving Tesla, it can drive her while she's on the computer. There's a lot of self-driving that's going to make stuff more efficient or better, like a Tesla. And I think that those are the ways that we need to start looking at stuff. One, if companies are going to cut costs, what are they going to do? They're going to cut employee costs, and then cost of marketing or advertisement. So any advertisement company in recessions go down 100% pretty much.
And
so
when's the last time you saw a Tesla commercial?
Ooh,
Never. They don't advertise. They don't spend those costs like Ford, GM. You know why? They're smart. They use social media. They use that's why Elon bought Twitter. So they're gonna dominate. And the point being here is, guess what? Yeah, the Magnificent Seven are doing better because they're way better. They're way better. That doesn't mean the market is gonna crash. They're way better than most of the other companies, right? The other ones
why
are
they way better? It's because they're smarter leverage. It's because they know employee costs and stuff. And that I can guarantee, just by being a business owner, and like you said, the stocks don't care about my business, but I know, just being a business owner, other business owners, and a lot of people are over leveraged right now, a lot of companies. And that's why I'm saying, like, it's not just pick the S&P 500 and pick the 250th best company and let's put $1,000 on them. We got to be smart with our investments right now, because vast majority of them, I feel, are going to plateau or pull down, most likely pull down, because they're not good at business, because they're over leveraged, because they're not Elon, because they're not Jeff Bezos, and because a lot of times businesses can be over leveraged and win. And we've had 10 plus years of being over leveraged and winning. And so people just are like, hey, I did that once, let me do it again, but even deeper. I did it twice, let me do it again, but even deeper. And I feel like that's why what is it, 84% of CEOs feel like there's going to be a recession, is because 84% of CEOs know, dang, man, I'm over leveraged right now. We'll recess it if it happens right now.
And they don't have the cash. And they don't have the cash, because here's the other
can't borrow it because it's too high.
It's too high. Here's the big part about here's a big other part about the Mag 7. And there's other stocks, right? There's other companies. They have so much cash on the side, free cash flow, that they're actually using the Fed's rate hikes to actually generate more cash. What they're doing is they're parking inside the money market funds. Their money market funds will yield you on your cash, right? So they're parking their tens of billions of dollars in the money market funds. And we don't know this as a fact, but it's we probably know under the hood they're doing this. They're basically funding their own growth, because they're collecting 5%. Now they can use that to pay off the 2 or 3% that they locked in. This is the other argument I have too, where people say, oh, well, the debt's too high, blah, blah, blah. Well, guess what? Nearly 50% of companies, they don't need to refi their debt till 2029, 2030. Therefore, right now with the high rates, they can use those rates to fund their debts at 3%, 3.5%, 2.5%. Plus they have cash flow. Plus they're benefiting from the Inflation Reduction Act, the CHIPS Act, the infrastructure bill, which basically is stimulus checks to semiconductors, creating chips, AI plays, renewable energy, electric vehicles, new infrastructure. So they're benefiting from all these things, and that's why they're going to keep getting better. That's why the NASDAQ is outperforming the S&P 500, because it has most of the technology software names in it. In the 1980s, A lot of the companies were oil companies and energy companies. That segment went from like 70% down to like 15-20%. So the
Hey,
markets change over time.
hey, Jeremy,
Yeah.
can I go over something real quick with you? I've seen that the one thing that you, and it's actually this other the CNBC one that I have up, Jeremy. Can you
Yeah, I
pop to
think I
my
got it
other
up
one?
there. Is it up there?
No, it's my other one. That's my notes.
Uh, you're gonna here. Let me put it back up because this is the only one that's showing up right now.
Okay, hold up.
Let me take it off and then you can put it back up there. While you're doing that, I'm going to read this comment. Regarding the point, this is Biggs. What up, Biggs? Regarding the point that increased goods and production is needed in conjunction with money printing, doesn't this go hand in hand with debt to GDP? Doesn't this imply that a high debt to GDP ratio is bad? Yes, it is. A high debt to GDP ratio is bad only unless, and depends on what you're talking about. It's only bad if you're not producing better technologies, a better lifestyle, and
You're not
lower
being efficient with the cash.
yeah, you
Like
got
I
to be efficient. You got to be efficient with the cash. Debt to GDP means nothing right now. Japan has the highest debt to GDP in the world, and their stock market is roaring. And their citizens are fine. They're not. They don't have crime. They don't have all this stuff. So it's more than that. People try to use the debt argument. It's all about how you're using it efficiently. Japan is the most efficient people in the world. They're actually the most efficient if you dive deep into it and see their culture. They don't do excess spending, none of that crap. So it's all
Right.
about production and technology at the end of the day. Number two, because it implies that we have printed a lot without corresponding increase in production. Yes, that's true. If you now over time, if productivity falls, then you're in trouble. You're going to have these. That's why we have financial crises, because at some point something breaks. It's not that the system is bad. It's that you get something slip. It's like, okay, I'm going to go, I'm not going to sleep. I'm not going to sleep. I'm not going to sleep. I'm going to work. Right. You're doing overtime. You're expanding you're using more energy than you're taking in. You're not recovering. And then eventually
Over
you fall
leverage.
asleep. You're over leveraging yourself. And then you fall with caffeine, whatever it is, cocaine. I'm just kidding. And then you fall asleep. You fall asleep for 1 second, boom, you crash. Now you have all these, you have to pay this bill. You get fined for this. You broke this law. So that's what happens. You eventually crash. And that's what we're trying to prevent. I know we print a lot during 08, but I don't think debt to GDP was particularly high. I mean, it's
I
not as
understand
high.
what's going on there.
Yeah. All the debt to GDP is going higher though. The point is, it's not about so much debt that you print, it's how productive it becomes. Can you make it productive debt? In the US,
100%.
it depends who's in the White House. The banks are very productive, regardless of what you think. Banks are smart. They're the smartest fools in the room. They are smart. They know what to invest in. They're making all the money on Apple, Amazon, Google, Facebook, Tesla, Microsoft over the decades. They're the ones doing the research saying most women are going to be single in the next 10 years. So let's invest in things that are going to pander to females, right? They're smart. It's the governments who suck with the money. They're the ones causing most of the inflation. Direct stimulus checks, bro. There's no production. You just spend it. What did you do? You created nothing. So government spending is typically the what causes inflation, in my view, and most people's view. Anyways, let me throw your stuff on there. Oh, I didn't see anything pop up. I wonder why it's not popping up yet.
Yeah, I'm not sure. I could clip it to the bottom. There's just a couple of stats I just wanted to go over. It's a CNBC article. It was October 3rd. It was created basically. Sorry if it's not showing up for you guys, but I'll just put a couple of stats up that it says. I know that kind of one of your thought patterns is, hey, savings is coming back up, right? I know that we have like $1 trillion of savings. I think in America. Is that correct, Jeremy?
Well, there's still $1 trillion of excess savings in U.S. consumers, which is, I think it's above pre-pandemic levels. I'm not sure, maybe not, but either way, there's still
It's
everybody
close.
they're expecting the excess savings to run out at this
Right.
time in October, November. There's still $1 trillion.
And I tried to do some research to figure out how they even get that number. Is it like just everybody's money, which I really think that that's what it is just everybody's money. So what, kind of is going to lead into what I think. I don't think that $1 trillion is saved up in the average American's pocket. I think it's the rich are stacking money because they don't have nothing to invest in right now. And I can see it. I'm trying to spend money right now. I'm trying to buy buildings. I'm trying to do stuff. Can't do it. Labor, it's too high. People are over leveraged. They can't sell the building. I can't buy the building, and it's kind of too hard. So what I'm doing is kind of sitting on money markets, whatever, until the right opportunity comes that I could capitalize on some of this pain that I feel is coming to this market. And this is some of what I'm thinking. I'm thinking it's probably the richer people that are stacking this $1 trillion, not just the average American. So on this thing, it says basically 3.9% in August of last year. So this is basically how much people save on their disposable income. It was 3.9% last year in August of this year. And it's well below the decade of 8.9%. That's decade average of 8.9%. We have this other one that says 49% of adults have less savings than a year ago. There's also a third have more credit card than debt cash reserves. And then 57% of Americans can't afford $1,000 emergency. And that's kind of gets to my point. And I understand, like we say, the bottom half of the country owns 1% of stocks, literally. It's terrible. They don't invest in stocks, but they are the consumers. And so once we stress the consumers, we have to be sensitive of businesses that are reliant on consumers and that haven't went through some turmoil like this.
Look at Rite Aid, just failed. Listen, defaults are happening at the moment. There are companies failing. But when it comes to the overall economy, those people that you say are rich, well, guess what? They're working for the tech firms. They're working for the Amazon, Apple. They have the biggest salaries, and guess what? Their monthly spending is like 10 people's monthly spending. So just to throw some context in there, the disposable income only shows that the economy is going to keep going. That the forward-looking earnings for S&P companies are going to continue higher and the earnings revisions went up again. Because people are going to keep spending as long as they have a job. When people lose their jobs, that's when you have a real crisis because they can't pay their debts. They're not spending in the economy. So the default and they can't spend in the economy. And it causes, a lot of stress and then stuff fall apart. But then again, I have a counter for that, which is, hey, in January, February, this guy, Joe Biden, you think he's going to pander to the people who are hurting, right? Any kind of credit card debt, blah, 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 whatever it is, he's going to come in and save you. He's going to print more money. He's going to come in and save you at some point. I'm not saying he will, but the likelihood of it in an election year is so high, especially given what their track record is. So I wouldn't even doubt if they keep spending going even further than that.
This is one thing that I wanted to ask you. On Pat Bet David, and I don't know if you have it, the lag effect. Did you cue that one?
Oh up? Yeah. That's another one. Do you want to run through this employment because we're kind of talking about employment here? Okay. We'll let him speak, and then we're getting into the lag effects. We're gonna get into lag effects really quick. Tigger Media, your question has to do with the lag effects. Can you give an example of what would be that breaks when you say something breaks? Yes, we're gonna get through that right now. Let me throw this back on. Hopefully the volume. Hey, real quick, tell me if the volume works. It's weird when I switch. It's like the volume doesn't work. Tell me real quick. Oh, what the heck?
What's going on? No.
Yep.
Oh, you can't hear. Okay. All right. We're gonna quickly run through. We're gonna get to the lag effects. That's like one of the last ones, but this is unemployment, credit card debt, which you were just talking about.
$300 a month. Now, this next one's going to be crazy because this next one, some people could say, Pat, this is why the market's not going to crash. And I'll give you the argument. Let me show it to you. So if you look at this chart, what this shows is the weighted average mortgage rate. So currently mortgage rates are well over 7%, in some cases at 8%, about 4% or 5% higher than the lowest mortgage rates we had set earlier in 2022. So this is like a year and a half ago. We're around 3%. Today we're at, say, 7.5%, 8%. Despite the sharp increase in interest rates, the weighted average rate has barely ticked up. Only those buying houses are affected by no mortgage rates, and there aren't many home buyers. So what this means is if you take everybody's mortgage loan, everybody's loan together, and you average it, weighted rate that they have, it hasn't increased because people are not refinancing. The refi business is dead today, right? Only the people that buy rates, and people are not buying as many houses as they did before because people are not selling, because those who are not wanting to sell, they don't want to go from a 3% loan to an 8% loan. You get the idea? How long this can last, no one knows, but they're still hanging on to that loan saying, I'm not giving up this 3% loan. Okay, so that was a breather. I gave you some bad news. That's a student loan. You got to pay it. Reminded you were kind of upset. Then I gave you some good news. This is the real news you want to know about why the market hasn't tanked. And when you look at this chart, this is
the lag effect. Now, he just talked about mortgage rates. That's another issue. Mortgage rates, people are not selling their homes because rates, the market is frozen. So you're not going to get a collapse. And disposable income, I don't have the chart up. Disposable income versus their mortgage payments is very high, or flipped around. Let's just put it this way. People have more disposable income than they did pre-pandemic versus their mortgage expense. So on average, because most people locked in at 3.5 rates, 3.5% rate. So that's why that's also an argument against a market crash. People still have disposable income versus their payments. And now we're getting to the lag effects. Did we miss the student loan? Did he talk about the student loan payment? Let me see, student loans. That should have said
the charts. If you don't have it, I have them on mine.
All right, I'll throw it on there. Yeah, because this is the lag effect. Here, let's just finish.
One second on the lag effect though, Jeremy, because I had a question for you. Okay, so if his assumption is right, he basically says an 11-month average, the lag effect happens from the recession to the time that they stop cutting or stop increasing rates, right? And so 11 months, he puts it as October of next year. Well, that's going to be right around election time. And I don't see a president being stupid enough to let the economy recess on a election year. Do you?
No, that's my argument is good luck on an election year. Good luck there being a recession. Yeah, he's going to print more money. So like I said, that first chart that I put up, it was earlier. It was basically some research done by this group, and they said the lag effect should hit the hardest mid 2024, which is literally the election year. There is no way. Either way, they're going to start talking about tax breaks. They're going to start talking about war programs, whatever it is. Part of the war. Yeah, part of the war is going to help with keeping that from happening. So some way, some shape, some form is going to be more stimulus, in my view.
And like I said, I got these charts if you want to go over the credit card debt for average consumer right here. So this is the chart that Pat Bet-David actually had on his. It just kind of shows this is consumer credit card debt, and it's actually topped $1 trillion now. This is a trillion mark right here. And so you can see consumers don't have extra income. They're actually putting it on the credit card more. And obviously, we could say, oh, well, we'll pay it off one day. But this will stress the consumer, because what ends up happening, and Pat said it in this, is whenever you satisfy the minimum payment. I had an employee one time, he paid $15,000 for a vehicle, right? And 2 years later, he was still paying on it. And I was asking him, how much he owes, and he owed $17,000 on it, And I'm like, how do you owe more? And it's because he was making minimum payments, right? So they just need me to make $50 a month. So I make that, but the debt keeps rising. And so this is what's happening to the average consumer. Oh, they can pay, the elevated rates, but then we can go down to credit card rates. This top blue line right here is credit card rates. And this is showing you that credit card rates are over 20% right now. And kind of jump. Cash is expensive, so credit card cash is more expensive as well. This is going to pinch the consumer a little bit as well, I think. These are, average family has $700 more versus 2 years ago, I guess is what it is. And that was 3 days ago. This, I tried to pull a different chart, but this just basically shows the same thing. This is actually in 2021, but the chart I should have showed the next 2 years, it goes about 600 and then 700 after that. But that just shows you, the average cost of the consumer kind of over time. Sorry, my camera cut out again. What's the average car payment? 725 versus 516. That's new car, but we could go to old car payments right here as well. And this is the used car payment. So before pandemic, 2021 actually was under 450. Now it's over 560. Even on a used car, you could see the the new went 250, and then the used went like 120 something. And so I don't know, it just kind of keeps going into, I do think that the consumers are getting more stressed right now. And I do think that they are going to have to eventually they're going to have a tap button. Hold on one second, Drew.
No, you're good. Yeah, so he makes a good point there. Now, Tigger Media, when you talk about something breaking, this would be it, where you're getting delinquencies, right? You're getting extreme delinquencies for vehicles, payments on vehicles, delinquencies start to rise. Also, credit card delinquencies start to rise. So what does that do? Spending starts to slow down a little bit. People get cut off credit. Some companies default, but again, into an election year, this is the perfect setup for this is going to be the perfect setup for whoever's in the White House or whoever's pandering to the audience to create more stimulus or cut taxes or some type of social program that is going to help with credit card debt, that's going to help with vehicles or whatever. They're going to say, oh my God, these companies, what do they say? The companies are they're greedy and they're taking people's money, blah, blah, blah. And so you're going to get people move to another industry, which is, if you're in the economy, yes, something could break, but the real breakage here isn't, credit card or vehicle debt. It causes a snowball, but the Fed is way ahead of this. They have QE. And just like I said, back in March of 2022, that was a bigger break. People miss this. Something broke in March we should be in a recession right now. We should have fell apart simply because right now, commercial real estate is on most of regional banks' balance sheets. If that breaks, as it is right now, it's breaking, then regional banks go down. They lose their deposits, and those deposits are basically, you park your money at a regional bank. What happens if you come back and your money's gone? You're screwed, right? You're filing for unemployment, jobless claims. Unemployment claims start to spike. Unemployment rate spikes. That's where you really see a deep recession. But again, the whole that's what should have happened in March of 2022. But the Fed stepped in. They secured all the deposits all the way up to, it's supposed to be 250,000 FDIC insured. They did more than that. They did up to 1 million. They did whatever. Janet Yellen's like, we'll do anything that you guys want. So at the end of the day,
I think the issue with at least SVB is there were companies. I think one of them was, I think it was like Peacock and PayPal. I think that they had both like $250 million each in that bank. And so you would have bankrupted that company if you took that money from them, right? The issue with it is, and as a business owner, I understand this, is you gain relationship with bank through having cash sitting in their bank or through doing business with them, loans and different stuff like that. And so the reason why they had $250 million in the bank is because they were able to access 0% loans. So everybody else have to pay, 8% loans. They were able to pay just basically what the bank pays for the loan. And it's kind of scammy thing, but that's why they had so much money in it. If you're a smaller business, you diversify. You don't have 250,000 in a bank. You diversify just because of the FDIC protection.
Right. And I want to show this really quick, which is to answer that question. Something did break. And I know we're talking about the economy, but this is simply what happened, guys. This was SVB right here. The stock market was actually rolling over because if you draw the trend, it actually broke the uptrend. It started to break down. We're about to, fall apart. SVB broke. There's a couple other regional banks. Multiple regional banks failed. It was the second biggest bank failure in history. But what happened? The Fed's balance sheet stepped up. They printed $500 billion over the weekend, and they plugged all these banks up and saved them. And yes, the balance sheet shaved off, but they're basically saying, okay, we're going to come in, we're going to keep doing QT, we're going to keep selling treasuries, but if something breaks, we're going to step in, plug the hole, and then continue with QE. So guess what? If something breaks, they come in, they plug the hole, they print more money. All that money, all that capital goes to plug the holes, but it also allows people to keep leveraging. Guess what they're leveraging in? They're going to leverage in stocks and asset prices. So Bitcoin also exploded right here. Went from 22,000 to 25, 26, made its way to 30. And then now it's back down a little bit because this is coming down. But either way, the point is something did break. We should have had a financial crisis, but the Fed stepped in. Who does this hurt? Oh, well, that's not free money. It's not free money. what's happening here is asset prices are moving up. And when they do this, it prolongs the recession or the break. And if you're just in wages, if you're just collecting cash, if you're spending your money too much, you're losing. You're losing because your prices are going to keep stair stepping higher. You have to own assets that outperform the Fed's balance sheet over time. It has to outperform this. If not, then you're losing when they print money. When they print money, you want to gain, you want to be, you want to benefit from them doing the money printing. But that's why I don't see a big recession, because maybe 2025, right? Maybe in 2025, you see a wide, long recession. By then, I don't know, because if employment does come back, people, you get debt forgiveness. It all goes to the Fed's balance sheet. Basically, your certain prices start to rise, and or they don't, because productivity is up and really assets go higher. That's the real trick. When they print money, something breaks, but you know what ultimately inflates? Assets, not necessarily goods and services. Not all of them. Some of them will, but mostly asset prices.
Asset prices. But what we got to make sure is that we're putting our money in the right assets, because like I said, stocks, yes, somewhat. Somewhat meaning, like, we're talking the best CEOs in the world will make money no matter what, almost, right? They're similar to the government, how you're saying, like, hey, they have so much manpower, so much brain power, that they're going to figure this out. Same thing for Amazon, same thing for Google, same thing for Microsoft, same thing for Tesla. They have so much manpower that they could throw at certain problems and find very smart solutions to certain problems. And especially people like Elon Musk, he's looking way the hell ahead. Jeff Bezos looking way ahead. They're like you're saying, they're looking in 10 years, figuring out, females might be more single, and how can we capitalize? Like, they're diving into these $100 million marketing analysis on some of their stuff to dive into their business and certain things that kind of help them. So the best businesses will. That's why I think that we should let these auto companies drown. I think that we should just let them drop, because capitalism will work. Eventually, what will happen is Elon will take over Ford, or Jeff Bezos will buy Chevy, whatever it is, and they're going to be able to make the product better and more efficient. And that's my standpoint. I think that you should let the banks fall. And obviously, this will be a little bit more, people think I'm a little more crazy on this, but I really think banks same way. You shouldn't be able to just go to Vegas and put 100 grand on black, and then if you lose, the government steps in. So if the banks fail, they fail. It is what it is. If the people lose money in the banks, the people lose money in the banks. It'll discipline people from thinking everything's free and everything will be okay. But I do agree. I do agree quantitative easing is coming. And I do agree that in an election year, it's going to be very hard to look like it's recessing, because they're going to try and prop it up as much as they can.
Hey, what bank do you use?
I got a lot of banks, man. I use a U.S. Bank, Chase Bank, and E&T are probably what most of my
They
money
all
is.
lost their deposits, and the government said, "Hey, we're going to insure your deposits," or not. What would you rather have, them insure your deposits, or say, "Sorry, you got to use a different bank"?
I would rather them insure my deposits up to $250,000, and then don't insure it after 250, because everybody knows the risk that they're taking. If I have 300 grand in the bank, then you can give me 250, and then everything else goes to the default of the bank to pay for people who invested in the bank or whatever. It's I don't know. It's if you have $250,000 in the bank, what FDIC means. You can't play stupid in the games like this.
So
I do think, though, that
the
FDIC should raise it to $1 million. I think that would help out a lot, because small businesses even operate over $250,000 of cash. So I think if they would raise it to $1 million, that would satisfy almost all small businesses. And then the big businesses would kind of have to work through several different banks.
Right. Okay. Fair enough. So the lag effects, I think you have this chart here. I think this is like the kind of like the last part to this. And we're going to go over gold, why gold is not worth it. He promotes gold. And I think we're both going to trash him on this one. Not him, but the idea of it, he's, hey, make your money, run your ads. Anyways, lag effects. This is the other part about the stock market. The whole argument is, hey, the stock market is going to crash probably. Blah, blah, blah. Okay, maybe 2028. You're going to keep pushing this out further and further and further and further, because really most of debt does not mature till not this year, not next year. Most of this debt doesn't, mature till much later down the road, 2028. I have another one. I have another chart that shows that not till 50% of the S&P doesn't mature till 2030. So we're not looking at a market crash anytime soon. Now, given a black swan event, we are not saying zero crash. If there's a black swan, right? If a war breaks out, a global war, if Russia jumps in, China jumps in, they invade Taiwan, if Iran starts using nukes, there's probably going to be something bad could happen. But outside of those,
an interesting stat. I don't know if we could do a case study on this or dive into it much. What debt is coming due in 2024 and what debt is coming due in 2025? Because those are the two candlesticks that I think they're gonna have
commercial real estate,
and they're gonna have to refi at this high debt. In 2 years, in 2025, that candlestick will have to refi at 7-8%, right?
But
so
hold
that'll
on,
double their payment probably.
But we're assuming the Fed's going to keep rates at this level. You know what I'm saying? They're saying, hey, we're going to start cutting. They're saying we're going to start. Go ahead. They said that they're going to start cutting in 2025. Forget what they say. Do you think they're not going to cut rates in 2020? Like if inflation continues on the path, which is back to 2% pretty quickly, why would they keep the rates and allow things to crash if they don't need to? Their biggest issue is inflation. So yes, refi.
I think that they will. I think that they will cut probably in 2025. If they don't print too much money, hedge that. Then they won't cut. I think if they print too much money, they won't cut because I think Jerome Powell's a grown up. But I do think that anything that's in 2024, like, so if we did a study on it and be like, what debt comes to maturity in 2024 and 2025, and maybe we see a company that's like, oh no, Tesla does have some debt coming, those two candlesticks will have to double their payment. So from a 3% to an 8% payment, it'll double your payment basically. So
right.
The 2024, and you could say, well, can we wait till 2026? But just think of this right now. Your house payment doubles and all you have to wait is till like 2027 to refinance it. Can you go 36 months paying double? And that's what some of these places are going to have, or some of these businesses are going to have to deal with, is if my debt is maturing in 2024, which you're an idiot if you didn't refinance in 2020, but or even 2021, 2022, when you've seen this stuff coming. But say that you didn't, say that you were a CEO that was, on Facebook too much, and 2024, 2025, who are these companies? Because we don't need to be investing in these companies, correct?
Yeah, no, not at all. There's a small basket of things you should invest in, honestly. Diversification is bullshit. Bro, all the people that made the most money, they were not diversified. They were in maybe 2 or 3 assets that they just stayed patient in, and they saw the future, and they went much higher, right? Diversification is kind of a myth. Warren Buffett doesn't even really diversify, to be honest with you. He made his money in the old regime, and now it's like, no, you buy Apple. His biggest position is a tech company. It's Apple, and he was against that for the longest time. That's the only reason that Berkshire Hathaway has made a lot of the gains is Apple, investing in Apple. So
right.
So anyways, lag effect. So those don't mature till later. If you don't have it, did you have anything else you want to add before we move over to gold?
Nope. I think that we're good on gold, or to go to gold.
All right, so we're gonna go to gold really quick. I wanted to debunk some of this, so check this out. When it comes to gold, see, hopefully this works.
Nope.
No. Why does it do that? That's weird, man. Come on, StreamYard. How about now?
About it. Based on what? Based on what case study can you speak so confidently saying nothing's going to happen? So look, I've been in the financial industry since 9/11, the day before 9/11, and I've owned stocks, bonds, mutual funds, real estate, crypto, gold, you name it, I've owned it. But the one thing that's very important part of my portfolio all these years is gold. I love having a percentage of my net worth in gold that I have access to in case of many different things. A few facts you need to know about gold. Number one, the gold market cap is $11.8 trillion. Since 2000, the compound annual growth rate for gold has been 9.24%. And during times of high inflation, 3% plus has been 15.35%. Now, those are just some numbers for you, but there's some other benefits to add gold to your portfolio. Number one, hedge against inflation. Number two, results showed recently that 93% of central banks are working on a CBDC. So this means what? That could be a manipulated currency that they own. If you own gold, it's a non-duplicatable asset. You're now hedging against CBDC taking place. Number three, a potential cyber threat. If it happens, you don't have access to your money, you don't have access to your accounts, well, you have access to your hard physical gold. Number four is anonymous. No one knows you have that gold. And last but not least, diversification. That's why we chose to work with our new sponsor, American Hartford Gold. If you have retirement funds that you cannot afford to lose, American Hartford Gold will ship physical gold or...
Okay, so that's basically his pitch for gold. And I don't even think he really believes in it. It's just, he's running an ad there. But
and hey, make your money, Pat Bet David, but definitely that's why he said I have a percentage of my wealth in gold instead of said 10% or something like that, because he doesn't have very much gold. He could carry all his gold, I would say, right?
Yeah, and he said exactly, and he said that there's a couple things he said that I wanted to address. Let me just throw on let's throw on the gold. I want to throw on the gold market really quick so we can actually see this. So he said that gold was a hedge again. Well, first of all, he said the compound annual growth rate is
9%.
Oh man, no way. Hold on, I lost my camera there. Dang it. I'll be able to turn this one on. He basically said that it's at 9.7%. Now, funny enough, what he did was he pulled it from the very, very lows, right? So he measured it not from here, from the look at the 80s. Gold is still down from the 1980s, bro. I mean, come on. So he pulled it from here, which is the very, very low, which is smart. If you're marketing, that's very smart. He pulled it. So the annual growth rate is 100.
I guess
100 and I'm sorry, not 100. The annual growth rate since 2000 is 9.24%, whatever. Now, the counter to that is this. Gold peaked in 2011. Okay, it peaked here. So, okay, well, you're pulling it from the low. Number one, if you measure the Nasdaq's up 2000%. So, okay, 100 and or it's up annual growth rate of 9%. I think Nasdaq's like 25% if you go from 25-30%. So, tech stocks do better. Also, this gold is up from the lows. This is a big move for gold. If you go to the highs, 100. If you go to today, it's up 150%. Bro, 150% in 23 years. Nasdaq is up 2,000% in 20 years. Bitcoin's up like 10 million% from its lifetime. Buffett doesn't even buy gold. Number one. Okay. Now he said it's a hedge against inflation. That's not actually true. When inflation started to hit, right, everything ran up and peaked at this point. So we've had inflation this entire time, right? 2022, gold didn't perform during the inflation rate. Like it didn't. It went lower. It moved with stocks. It did not it was not a hedge against inflation.
I think that there's a reason for that, though. I think generally it does, but I think with Bitcoin, there's another alternative to gold. So, and I don't know, I could talk for a little bit if you want to get your
go ahead.
camera going, but I feel like Bitcoin is a better gold right now because, and I forget what the guy is, the guy has the most gold or the most Bitcoin. Do you know that guy's name? He was on Pat Bet David's podcast as well. He's got thousands of Bitcoin or maybe millions of Bitcoin. I mean, he's a hedge fund manager and he put it all in Bitcoin. He was going over, why didn't you put it in real estate? Why didn't you just put it in stocks? Why didn't you put it in whatever? And he was going through the arguments and figuring out. And one of the arguments is, why don't you put it in gold? And he said, well, gold, almost every country has came through and regulated gold every 100 years. So gold is only good as the government allows you to keep it, right? Gold also it's impossible to transfer big chunks of it without having issues through border checks and through the airlines. It's impossible to transfer.
Inconvenient. It's
Exactly.
inconvenient. It's too heavy. It
Heavy.
costs security. Yep.
Exactly. There's inefficiencies in it. Who knows if this is gold? What are you gonna carry around with you? A gold finder or a gold? See if it's a gold, a real gold finder. And so, I think that Bitcoin is better than gold. And I think that what's happening is the people that would originally have put their money in gold to hedge against certain things, and they're like, hey, whenever times get rough, like this war coming up, you would expect gold to spike, right? Well, maybe it just transitioned to the digital gold, and say half of it now is going to Bitcoin versus the original investment in gold, because that's what I view Bitcoin as, is just a better gold, I guess. What's
Right.
your thoughts on Bitcoin?
Yeah, no, I mean, Bitcoin is basically, if you're looking into the future of digital gold, gold is the reason why gold is so such a commodity is because it doesn't lose its value. It can't be printed. It can't be manipulated through the Fed. Now, gold is one of the most manipulated assets, by the way, on exchanges. So you want to have the physical gold. If you buy and own gold through the miners, it's very manipulated. Most
Yep.
central banks own gold. The U.S. owns a bunch of gold. The market cap's 11 trillion. Where Bitcoin's market cap is 500 billion right now. So it's much smaller. Going forward, the world is transitioning to a digital era. And Bitcoin literally can't be debased because you can't change the process. If you pour $1 trillion or $1 billion of the Fed or the government says, hey, we need to mine more gold, they're going to increase the inflation rate of gold, which is around 3%. Bitcoin, you cannot change the inflation rate. It gives you what it gives you because it's programmable. It's yeah, and you could steal people's gold, by the way. If somebody breaks in and kills you,
Yep.
your gold, you can't take somebody's Bitcoin. The keys are in your eye. They're in your head,
And the
right?
hedge against inflation is getting out of cash. And that's why they say, hey, it's hedging against inflation. And it is, because you're taking this $1,000 and buying $1,000 of gold. And hopefully when the economy tanks or the dollar tanks, it's worth more than $1,000 in gold. So you kind of hedged your bet. But with Bitcoin, you get bigger upside. It's more efficient in its transfer. I could send it to you right now, Jeremy. You'd get it in 1 second.
Right. Instant settlement.
Exactly. It's instant. I could see, these poor countries that don't have a currency. They're just all jumping to Bitcoin. I definitely feel Bitcoin is the wave of the future. There was some news in Bitcoin, or I don't know the news, but I seen it jump to 30,000 there for a second.
Oh, the Bitcoin ETF. It was a false rumor that the Bitcoin ETF was passed by through BlackRock, and that just enables all pension funds, 401ks. So it jumped, but it was false. It was false.
And then there was something on Sam Bankman-Fried that had a bunch of money in gold, and they were in Bitcoin, and they were concerned about that. Have you heard about that?
Yeah, there's a bunch of money locked. They're trying to get out of their position and sell it. It's a bunch of fun. There's a lot of crap in crypto. Crypto has a lot of crap news.
Yep.
The FTX, the hackers in FTX are going to sell all their Bitcoin, move it to Solana. There's a bunch of just stuff that's thrown around there. But the big news is the Bitcoin ETF. Really, all the selling pressure is gone on Bitcoin. Nobody's selling their Bitcoin at this point.
And 98% buy, 2% sell on Bitcoin. Bitcoin, I think it's like something like 60% of it hasn't moved in 2 years or something like that. I think Bitcoin looked at as a lot more of a, hey, gold, buy it, sit it, and hold it, and hopefully in the future it goes to 100,000 or something. I think that's more. That's why I buy it.
Listen, gold is pushed by old fools. Warren Buffett doesn't even buy it. That should give you a red flag. Gold is pushed by these baby boomers who believe the end of the world is coming. Nukes are going to hit. They're holding on to this old stuff because they were taught it, because they don't have any frame of reference when it comes to technology. When it comes to the future, they trash everything that's millennial, that's Gen Z. They're stuck in their ways, and they think gold is the answer to everything, but they don't see the world actually changing here. You're better off buying freaking oil or energy. And the problem is that if you compare the actual returns of gold, are you kidding me? Go to the pandemic. Bitcoin from the pandemic right now is up, even though it's down 75%, it's up 650%. If you look at the pandemic when it comes to gold, the returns on Bitcoin aren't even close. Gold sucks. It's not even beating the Fed's balance sheet. These dudes they're just pushing, they just don't want to change their minds. Where's gold at?
Hey,
Gold
Jeremy, and I don't know if you want to do this, but you want to pull up a couple of these comments. We have one that a couple of them talking about gold. One says, I think the next gold cycle will be later, somewhere 2025 onwards, if ever. What do you think about that? Will there be another gold cycle?
Look at hey, by the way, since the pandemic, gold, Bitcoin's up 600%, gold's up 10-12%. Okay, great. That was during money printing. Gold goes up typically during money printing.
Yes, because
So
everybody starts realizing what's happening to their dollar, and they're like, hold up,
and
hold up.
that's where the use case of gold is gone, because
And people will
nobody's
be more
buying gold.
educated. In the future, people are going to be educated on this inflation stuff. There's a lot of people like me and you that are educating people on this inflation, and people are going to educate themselves with YouTube and all these different platforms to be able to be like, wait a second, they said, what about money? They're taking how much of my paycheck? I can only buy how many eggs now, you know? And
Yeah.
people will start waking up to it, and they'll start, I don't know. I'm not deep into all the crypto stuff, but I got and then I got Bitcoin, and I know that you're I think it was, what is it, Litecoin,
Oh, hell no, it's trash. Chainlink.
Chainlink. Yeah.
And we're gonna go over that because central bank digital currencies are here. They're coming. They're here to stay. They've been doing it. China's doing it. Japan's doing it. Countries are using them. It is the future. As much as, and Pat McDavid actually says this is a hedge against CBDCs. He doesn't even know what they are.
Yeah.
What is it? If I even told you what's a CBD, you don't know because we're not educated on that. Most people don't have no clue. Only software engineers in finance understand. They're just told CBDC is evil. It's bad for you, but there's a lot of benefits that we're actually going to go over. It's like credit cards. They're evil. They're bad, but everybody uses them. Anyways,
it's evil if there's a cashless society, though, because they can then, hey, truckers you want to act like you don't want to wear a mask or don't want to get a jab, cut the banks off, right? And that's what Canada just did, and that would be a lot easier on a CBDC versus a cat. I'm cool with CBDC. I'm not cool with it taking out cash, if that makes sense. I'm cool with both of them existing.
And they're gonna do it anyway. Like if you're okay, you're in cash. You think they're just gonna be? You think if the government wants to ban you, that you need to have cash, they're still gonna say, look at this guy's picture with AI. They're gonna see your picture. They're gonna see where you're at. They have your cell phone. You're screwed anyway. You're already surveilled. It's just silly. It's a silly argument.
No, it's not though, because I can go with cash. I could buy a gun. I could go with cash, and I could pay for. I could donate to a cause that I want. I could donate to Biden. I could donate
you're gonna
to Trump.
you're gonna buy a gun illegally from somebody illegally though. So you see what I'm saying? It's still, you can't buy if it's illegal for you to buy a gun because they banned you or whatever. I mean, you can't buy a gun even with cash because they're gonna demand credit. They're gonna demand that you use the CBDC. So you have to buy it illegally, is what I'm saying. So you know what I'm saying? Like cash isn't gonna. The only thing cash does is gives you privacy, but you really don't have privacy because if you have a cell phone with you, what are you gonna ditch your cell phone? Your cell phone tracks you 24/7.
My dad, he buys everything in cash, and it's and there's part of it to not be known where he's at, right? So
does he have a cell phone?
He does have a cell phone, but he don't use it.
It doesn't matter. He's still trying. You see what I'm saying? They're the old people don't realize they're already surveilled 24/7.
They can stop the transaction. So say that I think that the government says, "Hey, ban AKs," right? And I'm like, "Well, I want an AK. What if the alien invasion comes, right? What if Ukraine comes? All right, well, I want one." And then I go there and I say, "Hey, I need one of these," and the cell won't go through. He'll sell it to me, but the cell won't go through. And there's nothing else I could trade him. It's not like, hey, how about this? Maybe if I got some gold or something, but you're gonna have to have something. The freedom of cash is important in a free society because the government is 100% always trying to tighten down on their people. We see this with the money. What'd you say? They're gonna spend it inefficiently and come to you to get it. That's why you got to be invested, right? So the government's not gonna be for the people. They're always trying to overtake the people, and so this is another form of it. And me personally, I'll push back as hard as I can against a cashless society. I'm cool with CBDC.
Yeah. No, I hear what you're saying. You want, that's the thing is nobody's going to want to use cash, bro. Listen, younger people, the adoption cycles, they're not going to use cash. What it is going to be crypto. It's going to be crypto. So that's going to be your cash is going to be crypto.
Right.
Next,
and that's at least
you don't need because they're private wallets. So you don't necessarily need on certain cryptos. You don't really need cash. I'm against cash.
Do you have a ledger? Do you have your
Yeah,
crypto?
I have a ledger. Yes, I do have a
Okay.
ledger. Yeah.
Okay, good job.
All right.
Hey, anybody out there, and this ain't a sponsor for Ledger, but definitely go get some hard wallet. I've had issues with PayPal in the past. They actually stole about $18,000 from me because it was in PayPal's bank, and I fought with them for 4 years over this money, and they would never give it back. So I had to hire a lawyer and all this stuff. And anytime, this is why I diversified. The day that I lost that money, I diversified my banks because I was like, not one bank is going to be able to close me down and then I don't have cash. So I diversified, went to 3 to 4 banks for my business, went to 2 to 3 banks for my personal. And so I would definitely recommend to everybody, get your money where you access it. Get your stuff in dual spots. And then especially with Bitcoin, get a ledger, just so you never know with Coinbase and all this stuff when they turn into PayPal and they lock your stuff out, because they did it to me with cash. And it was about guidelines like, the company guidelines or whatever that I did, but they took $18,000 from me. So I think that's a big deal to in the future, to have your money where you can access it and there's not a third party being able to tell you yes or no on the accessing it.
Right. No, that's
Hold on one
100%.
time, dude.
I think the gold cycle somewhere in 2025 onwards, if ever. I would say, yeah. I mean, it's just a weak investment. Honestly, gold, you'd have to have a real global disruption. Again, it's a black swan event bet, I think, on gold. And if that, does it really perform? Because if there's a black swan event, the money printer is going to turn on. Bitcoin's going to outperform gold anyway. So I don't think it's lasting. What do you think about oil stocks? I think oil stocks are really good. They're positioned because they can utilize oil. They can not oil. They can utilize a lot of energy sources. But I think the big trade for oil is pretty much gone. I don't think that's your best bet, unless you have oil spike to 120. But Saudi Arabia, Venezuela, they're pumping more oil. The U.S. is pumping a record amount of oil. The energy transition is happening. You need a black swan event again for those to really boom. Your best opportunity going forward is not oil, but they're solid. If you just want to like hold it, they'll be solid. But I think this most people think the inflation is going to go back higher. I think $100 barrel oil is pretty much the cap. So oil stocks could go higher for sure. I don't know though. Chainlink, let's go. Yeah, let's go. Chainlink. Okay, Biggs with the Chainlink. All right. Chainlink's the best opportunity I've ever seen. Better than Tesla, better than Bitcoin, better than Ethereum. We're gonna get to that if we have time. Only thing I don't quite understand yet is the threat of CBDCs to commercial retail banking. Oh, they're screwed. That's the thing. They're gonna take out PayPal and all these guys because they're cheaper, faster, more efficient, instant. Dude, that's why I am so bearish on these retail banking commercial like Square and all them. They're cool, but bro, the government has to the government saw this coming a long time ago. They're the ones who invested a lot into blockchain technology. Blockchain technology eliminates all these side hustles. Really, they can still go higher, but it's going to be tougher. Anyways, no need to hold your money at a bank with a digital wallet. Why would the Fed want to destroy that? It's not so much destroy it. There's a lot of other issues going on in the banking system. It's just it's cheaper, it's faster, it's more control. They want more control 100%, but that comes with more benefits for the average citizen. It's a trade-off. There's always a trade-off. If you hold Bitcoin in a ledger, you can't necessarily transact with people, but you have value. So there's trade-offs. You really want to diversify how risk, not assets and investing, but if you're diversifying like the risk of you being shut out of the system, that's different. You're in America. If you're in America, you're fine. It's the people outside of America with governments who literally are communists. They're the ones who need the crypto system, not necessarily Americans. We're fine. Retail and commercial banking sector, unless there's some incentive for a bank to hold your CBDC, banks are going to get eliminated. Most banks will be eliminated, and they're going to just be using CBDCs. They're going to be investment banks because the Fed with CBDCs are going to directly transact with you for taxes, for stimulus. So instead of you waiting for a stimulus check, boom, instant. Like people love that. They're going to want that. They're going to need it. You're probably also going to get universal basic income in CBDCs also. Maybe if they offer yield on instead, the Fed still seems plenty of people would just debank. Yeah, yield is going to come through the assets that they provide. So you'll probably have CBDCs where you can also yield off something. Trust me, there's 10 steps ahead of us. It's the things you don't know about that are going to benefit the most. There's a reason why BlackRock is leveraging a Bitcoin ETF. There will be yield in those CBDCs. but not the way you think. There's going to be a segment where you can actually earn a yield somehow, and it's a safe yield. It's a this yield. And we think of the worst
there
governments.
already is on Coinbase. You can already earn yield off of your ETH. I know your Ethereum. You can earn 3% or something like that off of that. So I know that they already are doing stuff through Coinbase where you can.
Carbides makes a really good point. If Bitcoin was so perfectly untraceable, all cartels would use it exclusively. If anything, Bitcoin is more traceable if the transactor doesn't make an effort to ensure anonymity. 100%. That's the thing. Bitcoin isn't about fully, it's transparency. It's actually showing what you're doing. So Bitcoin doesn't keep you from the government. The government can trace you either way with the Bitcoin. The difference is they just can't take it. They can still find you. They can't take it. Now, when I say decentralized finance, that's where you get anonymity. I can't even say it. Anonymity, whatever.
Anonymity. I think.
Anonymity. Yeah, I can't say it. That's where you get it, is through DeFi, but they want to ban that. They want to take away your privacy as much as possible. And that's because of, who knows? Is it good? Is it bad? Who knows? There's probably a lot of policy towards that. Either way, Bitcoin doesn't, what it does is it keeps them from being able to take your money. It doesn't keep you anonymous. But if you're using Bitcoin transactions, you can see it on the blockchain either way. So yeah, you're right about that.
You can relate it to credit cards. You know, a credit card, the money goes because it's Capital One's money, so it goes through, and you can see, you know, the transactions on it. But they can, if they wanted to, come back and trace it. You know, so I think that I think the biggest thing with Bitcoin is the government can't stop it, and
there you go.
Freedom is what people
listen
love.
Biggs is pointing out also, not sure if anybody's familiar with the case. Look at, yes, Tornado Cash was on Ethereum. I think they're using Ethereum, and this, you couldn't see anybody. It was totally untraceable, and the SEC went after it. They basically banned it. It was a mixer that allowed for anonymity, and they jailed the guy, fined it. Yeah, they don't want that.
They're not going to let cartels send money through. You know what I mean? They're not going to. They're going to try and eliminate the drug trade for sure, or the black market with it.
Just don't break the law. Listen, you got to don't be stupid. It's not like everybody puts the worst case. Oh my God, we're going to get, the worst government of all time cracking down on us. People think, they try to put themselves in the worst case scenario, bro. Just don't break the law. Like, as simple as that. You don't want people breaking the law when it comes to you. So just don't break the law. Now, if we get a government that comes in, you have a lot that literally is trying to go after you for nothing. Well, we have much bigger issues socially than just money. There's probably other things going on. That's why you must vote correctly. You can't be fooled by these. We got to vote. We got to vote in this next election, bro.
What do you think about this Dogecoin is the future?
Hell no. I'm sorry, Bukowski. I do not see that. Maybe I'm wrong, but Dogecoin is just another. It's just another copy of Bitcoin. It doesn't. You can print as much as you can. There's like 5 holders. I think Dogecoin is trash coin. The only reason it's up is because Elon is promoting it, possibly for X. He could change his mind at any moment. He's very unpredictable. That's my thoughts on Dogecoin. It's a trade. You could trade it. But I think it's trash.
And I have Dogecoin, and I wish
he's capping. Bro, trolling. Yeah.
Okay. I was just making sure, because he seems pretty educated. So I was like, see what this is.
Nah, he was messing. He's messing around. So yeah. Anonymous. So he argues too that, okay, cyber attacks is a hedge against cyber attacks. But bro, if there's first of all, there's cyber attacks every day, Pat Big David. Okay, and I know this isn't really his, but there's cyber attacks every day. They happen all the time. The biggest cyber attacks might last for an hour, maybe a day. And so gold,
maybe not though. They just had a cyber attack on the casinos in Vegas and I think New York, and they had to pay them $10 million to unfreeze it, I think. And it took 3 days, I think 2 or 3 days to do so.
Well, for the average person, I'm saying a cyber attack, because he's pandering to the person. The cyber attack is meaningless for you. If you're running a business, then yes, you do want something that which is going to be a crypto at the end of the day, not a freaking a gold. Because what are you going to do with gold? If you have a cyber attack, you can't use gold to transact anyway. It doesn't make any sense. You need something. You need some type of infrastructure that actually. Gold is not an infrastructure. It's strictly a store of value. It is not an infrastructure for payments, for trade, or any of that. It's strictly a store of value. That's it. You put it underneath your mattress, you hide it. Unless you need a big payment, you need to buy an army or something big. Other than that, it's not a transactor. It doesn't make any sense. So yeah, the cyber tax is stupid. Doesn't make any sense. Cyber tax.
Biggs has another comment. I think he's kind of commenting on a little bit of the stuff that I was talking about, not to get too political, but isn't that far. Look at Canada. They froze bank accounts who donated to protests. The US is different, but I don't think we're too far off from that. And that's what I agree with. Is I really agree that the government is on a path to just control people. And obviously it's easier for a government if people are controlled by rule of law and, money factors and propaganda and all this stuff. It's better for a government to have your people in line. So that's why they do it. It's not like a mastermind thing. I just think it's the nature of government to overthrow its people or to try and control its people. And this is just another thing. We're I don't know. I always like to say we're like 10 years more or less liberal than like Europe, but we're close to that in Canada. We're pretty close. Like our policies get pretty close to them. If not, it's kind of like California leads the country and then everybody follows. That's kind of how Canada can be with some of this stuff, And so if our government looks over there and says, hey, they were able to stop them protests pretty easy by X, Y, and Z, maybe we should try and implement that. And I do think that the government is more controlling than people think on wanting to control the people. Another way why you want to invest in Bitcoin. Another way why you don't want to move to Canada.
Yeah. So and Bitcoin's mostly an asset for literally just money printing. It's not going to prevent you. The governments, if they want to get you, they're going to get you. They're using AI, Palantir. They're going to get you no matter what. Just don't do nothing stupid. Life's a trade-off. There's no perfect way of doing anything. So you just got to leverage your life to the best of your ability and make more money.
I don't know how close to the end that we are, but do you see my my thing right now? No, never mind.
No, what?
Will you go to Pat Bet David's video and go to 1730?
Yeah, let me go to 1730.
1730 to 1940.
All right. Let me know if you can hear it.
Nope.
Bro, that's annoying. Hold on.
It sucks that you can't see mine either because I have it.
You have what, the video?
Yeah.
I don't know if the audience would be able to hear it anyway because I'm using the StreamYard. So It's like when I play video, it has to go through a certain audio. It's weird. But sense. Here it is. Here's 1730 to what?
1940.
All right, here we go.
Want me to start my day being worried? Should I be stressed out? Someone just shared this video with me and I'm sitting here saying, the hell is this all about? Am I supposed to now lock it up and just not spend any money and not do anything? Here's all I'm saying to you is, I subscribe to the concept of only the paranoid survive. I'll give you a story and wrap it up. Last night, Sunday night, I'm playing Monopoly with my two sons and my daughter. One of my sons decides to play very conservative and he's keeping and hanging on to all the cash. He's not buying any property. It's like, no. So he's got the most cash. One of my sons, every time he gets cash, he's building a house. I'm going to build 3 houses on Indiana, Kentucky, and this. I'm going to build 3 houses on Vermont, this and this and this. And we're like, dude, this guy's down to $200. And then we land on it. Oh, you owe me $320. Okay. Hope you owe me $320. It's my turn. I'm going to buy 2 more houses and I want to build on this one. Okay. Boom. Oh, you owe me $550. I thought it was $320. I built 2 more houses. I'm going to go build now 3 hotels. Okay, how much is it? Oh, you owe me $900. Damn. And guess what? You don't have any money? I'll take that Park Place from you. But that's not fair. Or you can do it. So all of a sudden, he's got Park Place, Boardwalk. He's got everything going on right now. I want to build Park Place. And guess who lands on Boardwalk? Daddy. I land on Boardwalk. You know how much Boardwalk is? $2,000 that I don't have. So I got to give him 4 railroads. And luckily, I was able to negotiate a good deal. I give him electricity. I give him all this stuff. And I got to give him a couple, properties that I have. And next thing you know who ends up winning? The guy that took a little bit more risks than my other son did. And he wins the game of Monopoly. What does this mean? Does it mean go spend all your money right now? No. All it means is if your tolerance for risk isn't high, don't take it. But don't expect to make a lot of money if you're going to be super conservative. But if you have some tolerance for risk, this may be a good time for you to be shopping certain things, because the next 3, 6, 12 months, people may be very scared. And FYI, don't let the arrogance of people saying everything's going to be okay, the market's not going to crash, it's going to be a recession, soft landing. Whenever anybody says that, including myself, just kind of say, I don't think anybody knows what they're talking about. I'm just willing to listen to everybody. All I know is only the paranoid survive.
And, you know, that's what I like to wrap it up, Jeremy, because I know you think that you were right this whole time, but I think that we were actually both kind of speaking the same language. And I think that you agree with Patrick Bet-David even more than probably you think that you agree with Patrick Bet-David. I think from our standpoint, we're looking at majority of companies, we're looking at economy, we're looking at, you know, what could happen. And I do think we're correct on pain is coming. I do think that we're over leveraged, and I do think that we can, in the futures, there's going to be pain. But at the same time, there's also opportunity anytime that there is pain, correct? And so in my personal life, you know, I look at properties. I look at, you know, stuff coming down, getting good buys on it. I make the money on the buy, not on the sell. We need to be thinking of the same way through stocks, though. We need to be thinking of what are these companies that are risk, that we can take a risk on, and which are these companies that we can't take a risk on. Even some of these companies that we're already invested on, which ones do we need to transition into better asset classes for the next 1, 2, 3 years, so that we just don't take a nosedive in some of this, because there will be nosedive coming. But I do think that there's tons of opportunity, and that is why I get more excited than anything, is because the opportunity is there for the taking for those that are prepared. And that's all we're trying to do, is prepare you guys, you know.
Yeah, if the market crashes, buy more crypto. That's all I could say. Crypto's going much
Yes.
higher when they print. I still stand on, I don't see the market, the overall market really crashing unless there's a black swan. I just don't see it because there's too much cash on the sideline. There's a lot of policy, a lot of more stuff coming. If we do hit recession or start to slow, the Fed's going to reverse course to some degree. And if they don't, then the government, the US Treasury, the you know, whoever's running the White House, they're going to step in and do something about it. So you might get these little volatility will be there for sure, but an all out market crash to all time lows, hell no, it's not going to happen. That's where I stand. I hope you guys enjoyed the video. Enjoyed the content. Let us know if you guys liked it and what you want going forward. What do you guys want to hear going forward? What do you guys want to hear next time? Next Monday, we do these long talks whenever we can. Let us know. We'll schedule it. Just give us, leave it in the comments on the video, what you would like to hear about, what you would like to talk about. Maybe we dive into the war a little bit of politics, voting next year. Who knows what it is? Anyways, other than that, you guys stay blessed, stay fit, keep your mind straight, keep learning. We'll catch you guys next time. Thank you.
Thank you, guys.